Okay. So under we are going to be looking at pricing decisions, and we are going to be looking at the issue of limiting factor, where the entity will be having a plan that they want to carry out, but the resources are not enough to carry out the plan. So they have to now carry out the plan in order of priority. And how do we go about that? So we'll be looking at the issue of the limiting factor, relevant costing, another important area. Then we'll be looking at the issue of break-even analysis. Okay, issue of break-even analysis. We have other issues over there, which we call the shutdown decisions, keep or close, which the entity will be deciding whether they should discontinue production of a particular product or they should continue producing. And we also look at the make or buy. Okay, make or buy, the entity will be deciding whether they should buy the quantity from outsiders or they should produce it themselves. Then this one we look at the management accounting now. So we look at the management accounting in the public sector. So management accounting in the public sector is the same thing that okay, they are just giving the name to the thing to be in the public sector. So it's no longer in the in the private sector, but you are going to be using the same techniques. Those that they are saying, the cost benefit analysis, the cost effectiveness. No, I'm not sure you are going to be seeing question like that in the exam. You still see the question like it is in the private sector, but they will just change the name to be for a public sector. So you still be doing issues of the MPV, but in the public sector, it's going to be very simple because there is no issue of waterization. There's no issue of capital allowance. So there's no issue of waterization also as well. So it is going to be very simple. And you have the MPV, you have the internal rate of return, you have your basic payback period. So you'll be having your payback period, you'll be having your discounted payback period, you'll be having the accounting rate of return, and you'll be having your discounted payback period. Okay. And the issue of the profitability index. So these are the things that we are going to be looking at under the short term. Okay, the short term, these are some of the things that you have to look out for. But the question will come, the short term, the question will come for only one of them. It can be pricing, it can be limiting factor, it can be relevant costing, it can be break-even analysis, it can be shutdown decision, it can be make or buy. So it can be any of these ones. Okay, any of these ones. So we are going to be trying to see if we can actually capture 4 questions under the short-term decision making. Then we deal with the 2 questions under the what? Under the management accounting in the public sector. Charles, are you there?
Yes, sir.
I hope you are doing well.
Yes, sir, I am.
Okay. So just help us with the question number 1.
Okay, so question number 1. The managing director of Intams Manufacturing Company Limited, located in Lagos, attended a seminar titled Optimizing Scarce Resources Utility in a Manufacturing Setting with particular reference to linear programming. On his return after 3 days of the program, he called for a management meeting to discuss his experiences at the seminar in view of the board decision to produce 2 major products in the coming years. The following information are made from the work of a research team earlier conducted by a group of external research experts. The expected products are Biggie and Smallie. The expected cost statistics are as follows. So we have Biggies and then Smallies with their material costs, labor cost divided into 2 segments, being machining time and other processing time. The company expects to maintain a pricing policy that is hinged on total cost of production plus 20% markup on cost. The company further expects to incur annual period overhead of $10 million with normal production expectation of 200,000 units of Biggies and 100,000 units of Smallies absorbing the overhead on 3-2 basis respectively. It is expected that in the forthcoming year, the company will have the following resources available. We have materials to be 1,800,000 kilograms, machine time to be 800,000 hours, and other processing time to be 1,400,000 hours. You are required to, as the management accountant, A, compute the prices that will be adopted by the company for the two products using the company pricing policy, and B, advise the company on the outputs that needs to be produced to maximize its total profits, supporting your answer with full financial analysis.
Okay, so yeah, this question is a combination of limiting factor and at the same time the pricing decision. So they can give you information that they will be giving you a pricing decision. It's also under the short-term decision making. So the company can be using marginal costing, uh, they can be using full cost method, they can be using marginal cost plus percentage, they can be using even scheming, they can be using competitive prices. Yeah, they can give you a question where they will ask you to calculate profit lose using the pricing techniques of the entity. Currently, what is their pricing strategy? How are they pricing their items?
20% markup on cost.
Okay. The cost that they are talking about, the cost that they are talking about, okay, is it a full cost or is just a marginal cost?
The full cost.
Okay. So it means that you have to find the total cost. So you find the total production cost. The total production cost. You'll be having your fixed production overhead added to the marginal cost, then you find 20% of it. But other costs which are not relating to what? To production will not be part, like administrative expenses, selling and distribution. Those ones are not going to be part of this one because they are going to be settled from the profit that you are going to be what? You are going to be making. So they are talking about what? The full cost of producing, the full cost of what? Producing an item. So what is the full cost? What is the full cost? It will be your direct cost plus your what? Your fixed production overhead. Your fixed production overhead. So let's come to this place. And the company expect to incur annual period overhead. Company further expect to incur annual period overhead of 10 million with normal production expectation of 20,000 units of biggies and 100,000 units of smallie, absorbing the overhead on 3-2 basis respectively. Okay, so let's come to what they are asking us to do. Okay, as a management accountant, compute the prices that will be adopted by the company for the two products using the company pricing what policy. So let's determine the price now. Okay, so let's determine their pricing one by one and see what will be happening. So let's come to the A over there. So we look at the selling price. Okay, so we have the biggies over here and we have the smallies over here. So, okay, so what will be the composition of the total cost? Just what will be the
So
composition of the total cost?
the prime cost and then the overhead.
So how do we get a prime cost?
We have material and labor over there, and those
Okay,
are the prime costs. The overhead will be how the uh, $10 million will be shared between
okay,
the
so
two.
let's come to material there. Okay, material cost is what? Per unit. How much is material cost per unit?
$50 per unit.
Okay, so we have 50 for, that is for biggies, isn't it?
Yes, sir.
So the second one will be what?
It's also 50.
50-50. Okay,
Yes, sir.
so the labor cost is divided into two, isn't it?
Yes, sir.
So mention them. Let me see.
So $15 per hour for the two
No,
of them.
no. Let's just group them the way they are over here. So we have machine time.
Okay. And other processing time.
No, Charles, this is supposed to be 250. Biggie, the cost over here is you are incurring 50 and you're using 5 kilogram. So that we are looking for the cost per unit. Cost per unit. So that will be 5 multiplied by the 50. Cost per unit. Cost per 1 unit. Okay. So that will be 250, not this one. Okay. We are not looking for the cost per kilogram. The cost per producing 1 unit of biggies. That will be 250. Okay. Then the small is what?
150.
Okay. I hope you're okay now.
Yes, sir.
Okay. So machine time will be what? The labor hours using the labor cost on the machine is going to be 60. Is that 60?
Yes, sir.
Okay. For small is what?
For small is 30.
30. Okay. Then we have other what?
Other processing time.
Okay. Other processing time. Okay.
40 and 50.
40 and what?
And
50.
50.
Okay. So let's put the two together and have our prime cost. So what will be the prime cost? Would this be 350?
Yes, sir.
And this will be 230.
230.
Okay. So we have our prime cost to be 350 and 230. Let's come here. Okay. They are saying the company further expect to incur annual period what? Overhead. Annual period overhead of 10 million. Okay, with normal production expectation of what? 200,000 units of biggies and 100,000 units of smallies, absorbing the overhead on what? 3 to 2 basis respectively. Okay, can you absorb administrative overheads on production?
No, sir.
Okay, so what they are telling you over here is, unless the question is saying that included in the overhead is administrative or selling what? Issues. Okay, so this is an overhead that is being absorbed based on production. This is a fixed production overhead. This is a fixed production what? Overhead. Okay, unless the question is telling you that we know that overhead can be administrative one, but what we are talking about over here is a production overhead. Administrative cost, if you are incurring administrative cost, it will be on the number of employees. Okay, on the employees that you have over there, it will be on different basis. The only overhead that's mostly absorbed based on production is a fixed overhead. So they are saying that this will be absorbed on a basis of 3 to what? To 3. So 2 is to 3, isn't it?
3 is to 2, sir.
3 is to 2, isn't it? Please, they are not using, don't go there and be using the production, their production level to what? To share the fixed overhead. No. The question is telling you that this should be shared in the ratio 3 is to what? Is to 2. So which of them is taking the 3 and which of them is taking the 2?
Biggest takes the 3 and then smallest takes the 2.
Okay. So let's come here. Let's come to this place. So I'll do some small workings over here for the production overhead. So let's have some small workings over here for the production overhead. So we have the production overhead of what? Please a minute. Let's proceed. All right. So we come to biggies over here. Okay. What would be the sharing ratio? Three over what?
Over 5.
Okay, 3/5 multiplied by 10 million. What are we having?
6 million.
So we're having 6 million for this one. This 6 million, this 6 million is on what? Is on the total production, isn't it?
Yes, sir.
So how do we find the fixed overhead per unit?
Divided by 200,000.
Okay. So overhead per unit Okay, that will be 6 million divided by the total units, isn't it?
Yes, sir.
That will
100,000.
give us 200,000 units. What are we getting?
30 dollars.
That was 30.
30.
Okay. So smally, what will be smally? We don't even have to check whether we don't have to calculate. We know that the difference will be 400, isn't it? The
Yes, sir.
difference will be
4
4
million.
million. Okay. So 4 million divided by the
Million
unit for them.
100,000.
Okay.
So
100,000.
40.
That would
That
be
will give
40.
us
That's 40.
40 per unit. Okay. So we can come over here and have our fixed overhead now to be 30 and 40, isn't it?
30,
Yes,
40.
sir.
So
Okay. So what will be their selling price?
380 and 270.
Okay. 380 and what? 270. So that is the selling price for each of them. Okay. I hope that is fine. Okay. Compute the prices that will be adopted by the company for the two products using the company pricing was policy. Okay, so that is the selling price now. Let's come to this one. Advise the company on the output that needs to be produced to maximize.
Linus,
Yes, please.
please, I think the question said the company expects to maintain a pricing policy that is
We are listening.
So we didn't use the markup of 20% on the cost
Oh,
to get the
Yeah.
selling price.
sorry. So this is the total. Oh, sorry. Oh. So we have the markup of 20%. So 20% is what?
76.
76.
So this is how I'll go to the exam hall thinking that I've killed the paper, but I haven't done anything. 0.2 multiplied by 270, and now that's 54, isn't it?
Yes,
Yes.
sir.
Okay. So the total selling price is now what?
456.
456. And this one is what?
324.
324.
Yes, sir.
Yes.
Okay. So I hope that is fine now.
Yes, sir.
Okay. I was taking the 380 to be selling price. I was thinking that the fixed overhead is a profit. It's normal. Okay, so let's come to that is a selling price now. Okay, this one you can see that the question has given you some of the what, some of the material, some of the input that you are going to be using. They are giving you some of them, isn't it? Okay.
Yes, sir.
The reason for giving you this one is that one of them will be limited in supply, or any of them can be limited in supply. So what we have to do is we have to ask ourselves, if we want to produce based on our demand now, okay, 200,000, 100,000, what would be the quantity of raw material that we have to use? So we have to look for the input requirement for the two products based on our demand. So we do that for material first. So we'll be doing that for material first. So let's look at the raw material requirements. Okay, so let's look for the raw material requirements. Okay, so for biggies, what will be the total raw material that we have to use? We are producing 200,000, isn't it?
Yes, sir.
And we are using how many quantities for a unit?
5 kg.
Okay, so we have 5 kg. So how many kgs will be used?
A million.
A million.
So we'll be using 1 million kg. Okay, so we have 1 million kg. So smallies. So
Also
let's
5.
So we have 100,000 multiplied by, is it 5 or 3?
3.
Okay. That will give us 3 kilograms. And that will give us 300,000, isn't it?
Yes, sir.
Okay. The total will give us what?
1,300,000.
Okay. What is the total quantity available?
1,800,000.
So it means that for material we have plenty material to be able to produce up to what we want, isn't it?
Yes, sir.
Okay. So let's come to machine time now. One of them will actually be a limiting factor. So let's come to machine time now. Machine time will be what? Biggies will be what?
4
200,000
hours.
multiplied by
4 hours.
4 hours. What are you having?
800,000.
800,000.
600,000.
800,000. Somalis will give us what? 100,000 multiplied by
By
2.
2 hours.
Yes, sir.
That will give us 200,000. So total will give us what?
1 million.
1
1
million.
million.
1 million per.
Yes, sir.
Okay. So that will be 1 million. But what is the hours that we have there?
800,000.
800.
So it is possible that this will be the limiting factor, isn't it?
Yes, sir.
Okay, but let's try the order
Yes.
processing time. Okay. Let's try the order processing time. Order processing time, biggies will be 200
4 hours.
multiplied by,
By 4 hours.
By 4 hours.
okay, by 4 hours. We are having 800, isn't it?
Yes, sir.
Yes.
Okay. Smallies will give us what?
100,000 by 5.
Okay. 100,000 by,
5.
okay. And that will give us 500.
500,000.
Okay. What will be the total?
13.
Okay.
1.3.
Okay. But what is the distance that they are giving to us over there?
1,400,000.
1.
So do you have capacity? Do you have the capacity to produce all the quantity?
Yes.
Okay. So it means that machine time is now the what? The time that the workers are going to be using on the machine is the limiting factor, isn't it?
Yes, sir.
Okay. So it means that we have to now make a decision to what? To the machine that we are going to be using. So let's now look at what is the contribution per unit. If we decide to produce each of the units, how much are we going to be getting before we take care of the fixed cost? Okay, the fixed cost, we then actually include the fixed cost in our decision, unless the fixed cost is a specific fixed cost. Okay, the fixed cost, even if you produce one of them or you are not producing any of them, you can still incur the fixed cost. If the fixed cost is the rent that you are paying for the factory, if you are not producing, you still pay the rent. So the fixed cost is not part of it's not part of the decision, but we only take into consideration those costs that can be avoided if we decide not to if we decide not to take this particular decision, unless the fixed cost is is a specific fixed cost. That is the only time that you can consider it in the decision that you are going to be making. So you'll be looking at so you can call this one statement of ranking. So anyhow you call it, statement of ranking, or someone can say statement of decision, any of them. Okay. So we are going to be looking at the products here. The product we have smallies and this one. How do we calculate contribution?
Selling price minus variable cost.
Okay. So we have the selling price for each of them. We have done that, isn't it?
Yes, sir.
456 and 324. So 456 and 324, isn't it?
Yes, sir.
Then we just take out the prime cost because we have done workings for the prime cost. You don't have to come and repeat material and labor here. No, You have done that already, and the prime cost is 350 and 230, isn't it?
Yes, sir.
Yes.
Okay. So we have 350 and 230. How much are we getting per unit?
100.
106.
Yes. 106.
Okay, and this one give us what?
94.
Okay, 94 or 96.
4.
Okay, so we have the contribution over here. So it means that if you are producing 1 unit of biggie, we are going to be getting 106, isn't it?
Yes, sir.
And 1 unit of smallie, we are getting 94. Can you go ahead and say they should produce biggie? Can you tell
No,
them
sir.
they should produce biggie?
No.
Why? Why
No,
you
sir.
cannot tell them that they should produce biggie?
Because they don't use the same amount of material. You have to weigh it with the material they use.
They don't use the same what?
The same
Machine.
quantity of material.
Machine hours.
Machine time. Machine
The
time.
machine hours.
Sorry. It's fine.
Oh, don't worry, we are all together. Okay. So whatever happen in the class, when you fall, we can actually lift you up. But in the exam hall, if you fall, we cannot do anything there. So we can actually do something over here. So this one, okay, the machine time is the what? Is the limiting factor.
Bottleneck.
Okay, is the limiting factor or the bottleneck. Just it means that you are transferring knowledge. Okay, so is the limiting factor. Okay, we cannot just stand up and produce anyhow. What we are going to be utilizing, we have to utilize the thing for the one that is going to be giving us the highest what? The highest return. Okay, we are getting 104. Okay, and we are getting 94. This 104, it means that we are using 4 hours to get what? The 106, isn't it? We are using 4 hours
Yes,
to get
sir.
the 106. And we are using 2 hours to get what? 94. Okay. Now you cannot say 106, 94. They should go ahead with the one that is going to be giving them 106. No, they are not going to be using the same what quantity or the same amount of the limiting factor. No, you are using 4 hours to get 106 and you are using 2 hours. Which of them should you go for? The best way to do this comparison is that, okay, if I'm using 1 hour of the machine time, how much am I getting for the biggies? The smallie, 1 hour of machine time, how much am I getting? So you do it to be a common base where there will be the contribution per hour based on a limiting factor. So this is actually for 4 hours. So if this is for 4 hours, so Charles is saying that this is bottleneck. So under throughput, the limiting factor is called a bottleneck. So this is for 4 hours. This is for 2 hours. So how much are you getting per hour for the biggie? How much are you getting per hour for the biggie and this one?
2.26.5.
6.5.
26.5.
26.5. And this one we are getting
47.
47. So you can see that 1 hour of the machine time is giving you what? 47 return on what? On smallies, but the biggie is giving you what? 26.5. Which of these ones are you going to be producing first?
Smallest.
Okay, so you produce this one first and you produce this one second. Please, sometimes they can also give you something like this. I've said it before, I will say it again. They can say that the company has received what? Order from what? From somebody that the company have to. So the company has received what? Some order for biggies now. Okay, the company has received some order for biggie now. And they say that before they even produce, the company has to what? Has to make sure that they satisfy that particular customer's order. If not, they are going to be paying penalty of a certain amount. If not, they are going to be paying penalty of a certain amount. How do you consider that particular issue? Okay, you have to consider the impact of the penalty. You have to consider the impact of the penalty. How do you consider the impact of the penalty? Let's come here. For every unit, okay, let's come here and say that we can see that biggie, the machine time over here is only what? Is only It's going to be 200,000 hours. Okay. Okay, this is not throughput. Okay, but we are writing the limiting factor to be a bottleneck. This is not throughput. Okay, so we have the limiting factor here. Let me just write the limiting factor here. Okay, so you can see that for this one, okay, for Smalley over here is only, you are going to be using only what? 2,000 hours. Okay, you are going to be using 200,000 hours, and the remaining one will be for what? The remaining one will be for the biggie. So maybe you can actually satisfy the demand of that particular what? That particular customer. But I want a situation where you cannot produce any unit of what? Biggie. You use all the available hours to produce that unit of what? That quantity of Smalley. Okay, that is what we are going to be doing. So let's assume that we are not going to be producing any unit of what? Biggie. And the customer has placed order for, let's say, 20,000. Okay. The customer has placed order for 20,000. The customer has now placed order for 20,000. Okay. We are not producing any unit of biggie. This particular customer has now placed order for what? For 20,000. And we are saying that if this particular quantity is not supplied, we are going to be paying penalty of 10,000. Okay, let's come here. We are not producing, we assume that we are not producing any unit of biggie, so that I can actually show how you take into consideration that particular effect. So if you're not producing any unit of biggie, it means that you are going to be using the hours to produce what? To produce Smalley. So you are producing all the units of Smalley. Okay, let's come here. If you are producing and selling to what? Selling to the customer, what will be the contribution that you'll be getting per unit? If you are producing biggie,
106.
106.
okay, you'll be getting 106, isn't it?
Yes, sir.
Okay, and there won't be any penalty, isn't it?
No,
Yes.
sir.
Okay, so if you are producing and selling to customer, you are getting 106 per unit, and there won't be any what? There won't be any penalty. Okay, there won't be any penalty. Okay, now you are not what? You are not what? You are not producing now. So it means that you are going to be losing the contribution at the same time that what? You are going to be losing the contribution at the same time be paying the what?
The penalty.
You'll be what? You'll be losing the contribution at the same time you'll be paying the penalty, isn't it?
Yes, sir.
Yes.
Okay. So let's come here. The customer has placed order for what? Order for 20,000 units. Okay, you are losing a contribution of 106 on the 20,000 units. Okay, you are losing a contribution on that particular one. Okay, you are losing a contribution on this one. If you don't produce, you are losing a contribution. And you are going to be paying the penalty also. So the total cost that you are incurring now is the contribution, because the variable cost will be saved. So if you don't produce, although you are going to be losing the selling price, but the variable cost will be cost savings for you. So we only take into consideration the contribution. So the contribution will be 106 multiplied by the unit that you are not producing, and you are going to be paying the penalty also of 10,000. This is what is going to happen. Okay, let's come here. If you want to produce 20,000 units, how many hours are you going to be using to produce the Smalley? If you want to produce 20,000, how many hours are you going to be using to produce the 20,000?
80,000.
That will give us 80,000, isn't it? Okay,
Yes, sir.
Yeah.
we are going to be using 80,000. Since we are not producing, it means that this 80,000 will be used to produce what? Okay, since we are not using these particular hours to produce biggies, it means that the 80,000 will be used to produce Smalley, isn't it?
Yes, sir.
Yes.
Okay.
Mm.
How many units are you going to be producing from Smalley if you are using the 80,000 hours?
20,000.
How many units can you produce? Is it going to be 20? We are using 1 unit is 2 hours. If you want to produce smally, how many quantities of smally can the 80,000 hours that you are saving produce?
40,000.
That would be
40,000.
40,000 units. Okay. That would be 40,000 units. And what is the contribution per unit?
94.
94.
So you find the contribution over here, which will be 94. What are we having? Let's find the two figures and I will tell you the impact of that particular one. Okay, but this one is only two.
3.760.
That will give us,
3.760.
okay, so we have 3760. Okay, what will be the total amount that we are going to be losing under this one? We have 20 multiplied by 106. I'm having 2120, isn't it?
Yes.
Okay, plus the 10 over here, isn't it?
Yes.
Mhm.
So
And that will give us
2130.
2130. Okay, is it better using the hours to produce smally than what you producing now to satisfy that particular customer? Is it better sacrificing the hours to produce smally, or we should just leave that one and now produce what? Biggie. In
So
terms
you
of
have
what
to
we have done,
produce the smally.
we have to produce the smally because the smally will be giving us additional cost, additional benefit of something like 3760 minus the cost that we are going to be incurring. Okay, please forget about the loyalty of the customer or those kind of things. We are going to be basing our argument on figures because they haven't given us any issue about how important that the customer is to the entity. So sometimes they will give you the penalty. You have to consider the impact of the penalty. So if you don't want to produce that unit for the customer, okay, what is the impact? You are going to be losing contribution and you are going to be paying penalty. Okay, the hours that you are going to be you are going to be saving now, which of the units are you going to be using to produce what? Are you going to be using the hours to produce? Then you find the benefit of you now using that particular hours to produce that quantity, compare with what? With the losses that you are going to be suffering. If you are not producing, you are going to be losing the contribution. At the same time, you are going to be paying a penalty. So the money is going and you are still adding money to it. That is the issue. But now the product that you are going to be using the hours to produce, what is the benefit that you are going to be getting by sacrificing that hours that you are saying that you're not going to be using to produce the quantity for the customer? What is the benefit there? You compare the two. If producing the other quantity gives you the same, gives you what? A better benefit than what? Producing for the customer. You go for that one and pay the penalty. No problem. But if the benefit that you are getting is lower than the cost that you are going to be incurring, then you just have to produce and use that particular hours to produce for the customer. Okay, they can give you a question like that, and you have to actually work out that particular one. Okay, it's something that came to my mind, but just I don't have question on it. Okay, that's why I'm using the figures to demonstrate. Okay, so let's now come to the production over here. So let's come to our optimal production plan. So the question can ask you to determine, the first question will be determine the optimal production plan. Please, you cannot determine the optimal production plan without doing the ranking. Okay, you are using the limiting factor. So how much, when you produce 1 unit, how much is it going to be given to you per the what? Per the minute that you are using. That is what we do. So we come to the optimal production plan. You have your product over here. Okay. Then you have your demand. Okay. You have your product over here. You have your demand. You have your hours required. Then you have your total here. So we are producing smallies first. Okay. We are producing all the units of smally, isn't it?
Yes.
Yes, sir.
Okay. And now we are using 2 hours, isn't it?
Yes, sir.
Yes.
And the total hours will now be what?
200,000.
Okay. Then we now produce biggies. Okay. So how many hours will be left that we are going to be using to produce biggie?
That's
It's 600,000.
600,000.
That will be 600,000, isn't it?
600.
Yes, sir.
Okay. We are going to be using a total hours of 600,000 to produce Biggie. But how many hours are we using to produce 1 unit?
4
4 hours.
hours.
So how many units at 4 CD? At 4 hours will give us the 600,000 hours.
150.
150,000.
Okay, so we have the 150,000. So you can stop over here. But last time I was saying that you can actually do this one to be 250. Okay, but they are not the same. They are not the same product, so you cannot add them. But most of the time, this is what we do. You find a weighted average what number of hours that you are using to produce one. So 800,000 for 250. How many hours are you going to be using to produce that? I'm having 3.
3.2.
Okay, so you can actually do this
3.2.
one, or you can just total your hours. The products are not the same. They are not the same product. You cannot add green and yellow together. No. Okay, you cannot add green and yellow to get one result. No. So you can leave the product, but most of the times we do it to get a weighted average what number of hours. That is also fine. Or you can just add your 200 and the 200 and the 600 and move on because it's the same hours that you are using. Okay, so advise the company on the output that needs to be produced to maximize its total profit, supporting your answer with full financial what analysis. So let's assume that the question is asking us to determine the profit that will be gotten from what this particular production plan. Although they are not asking us, this is what they are asking us to do. But let's assume that they are asking us to determine the profit. How do we go about it? So if they are asking you to determine the profit, this is what you do. You have your profit statement over here. Profit statements. Then please don't go and prepare profit statement and be saying that revenue less variable cost. No. You know your contribution per unit already. Every unit of Biggie that you are producing, that it will give you 106 per unit as a contribution. So just start with the contribution. Okay, because you have done selling price, you have done prime cost, you have done calculation already. If you haven't done anything like this, that is the time that you are coming to be showing the revenue and those ones. Start with the contribution. Okay, because you have done contribution over here already. So you are just lifting from that place. That is all. So you come to your contribution over here. So you come to contribution. The contribution, you do the two. You can do them in a bracket or you can go and do working somewhere. So we have 106. 106 over here. So we have 106 multiplied by, we are producing 150,000 units of Biggie. Is that correct?
Yes, sir.
Yes.
Okay, plus 94 multiplied by 100,000, isn't it?
Yes, sir.
Okay, what will be the total? Keeping 3 zeros at the top.
Biggie gives us 15,900.
Okay, if you add it to what are you having?
That's 25,300.
25,300. Then you just subtract your what? Your total fixed cost or your total variable cost. So total fixed cost or total variable cost. Or if they ask you to do it for each of the units, we know their prices already. So you just calculate their contribution and you take the what? The proportion of their what? Of these their figures. And that will give you 600,000 for Biggie. This is a fixed cost. So whether you produce 1 unit or not, that will still be the same. So even for the 150,000, Biggie will still be incurring the same cost. Okay. And the smaller will be 400,000 if they are asking to do it separately. But this one, we are doing it for total. So we have this figure over here. And we have 15 what? 300. And that will be the total profit based on what? Based on our production plan. Based on our production plan. If they are asking you for profits, okay, they can actually give you some other courses again, other fixed costs. They can be administrative selling. You have to bring them and subtract. Okay, that is basically about this particular question. Any issue before we move on to this one?
Hello, Sam.
Yeah.
Is which fixed cost are we using? The 1,000? Is it 10,000?
It's 10 million. We are keeping 3 zeros at the top.
Okay. Yes, I'm wondering where it skipped me. Can we go back to that? The question. The company further expects to incur an annual period overhead of 10,000.
10 million.
Sorry, 10 million. So that is it. Oh, okay. Okay, thank you.
I hope you are here now. Sorry, I didn't hear what you're saying.
Yes, I've gotten it now. It's fine. Thank you.
Okay.
I have a question over there. So now that it wasn't clear whether it is variable overhead or fixed overhead, so we are just assuming it is fixed overhead, or it is stated somewhere that I
See that what you are saying is not a question, Osinia. It is a concern, but not a question. Okay. So what will happen over here is the company further expect to incur annual period overhead of 10,000 with normal production expectation of this one. So in cost accounting or in management accounting, the only cost that is mostly what apportioned based on the what based on production is the annual fixed production overhead. So you can see that the company is using what? You can see the company is using marginal costing over here, isn't it?
Yes.
Okay, and they're also saying that the company expects to incur annual period what? So under marginal costing, fixed costs are treated as period costs, isn't it? Okay, so unless the question is saying that included in these fixed costs is administrative expenses or whatever, then you just now find the administrative one. So this one is entirely the fixed production overhead. So I hope we are done with your concern now.
Oh yes, sir.
Okay,
Thank you, sir.
just let's try this one, then we see what we can do. Number 2, just are you there? Just are you talking?
Maybe one female can take
It
over.
seems she has dropped from the call. He has dropped from the call.
No, it's this one. It's, so wait, Charles is there. The network is bad.
Oh, okay.
Auntie Vic, we are waiting for you.
Sorry.
Someone is
Testing
saying that
two.
if a lady is reading, like he normally focus more than a guy. So read.
Oh, God. Question 2. Dementia Limited is involved in the design and manufacture of custom-built factory equipment. The company has just received an inquiry about the supply of 10 machines from one of their regular clients, Kukua Limited. Kukua Limited has informed the company that the maximum price they are willing to pay is 5,200 cedis per machine. The order would need to be completed within 2 weeks. The following details relate to the production of the machines. 1. Materials per machine. 10 units of material A, which is used regularly by the company. The company has 120 units of material A in stock, which originally cost 120 cedis per unit. The replacement cost of material A is 20% higher than the original price. 2. 5 units of material B. The company has 40 units of material B in stock, as it was purchased a few years ago for use in the production of other equipment. If the company no longer produces. If this material is not used in the production of this order, it will never be used again. The original purchase price for the unit of material B in stock was 190 cedis per unit. The replacement cost of material B is 150 cedis per unit. The net realizable value for a unit of material B in stock is 130 cedis. 3 units of material C. This type of material is regularly used and usually costs 85 cedis per unit. However, the company's current supplier earliest delivery time for this material is in 3 weeks' time. An alternative supplier could deliver immediately but will charge 90 cedis per unit. Sementia Limited already has 600 units in inventory, but 580 units are needed to complete other existing order in the next 2 weeks. The remaining 20 units would not be needed until 5 weeks' time. 2. Labor hours per machine. 12 skilled labor hours would be required. Skilled workers are paid 20 cedis per hour and are part of the permanent workforce. Please kindly scroll up. Okay. At present, there are 125 paid surplus skilled. Hey,
Take it again.
yeah. 2.
6.2 again.
Labor hours per machine. 12 skilled labor hours will be required. Skilled workers are paid 20 cedis per hour and are part of the permanent workforce. At present, there are 125 paid surplus skilled hours per month. Skilled workers are paid time and half for overtime. 22 unskilled labor hours will be required. Unskilled workers are paid 15 cedis per hour and are employed on a casual basis. 3. A supervisor with the necessary experience in the production of similar machine, who is currently paid 56,500 cedis per annum, will be transferred to the job. This will necessitate the hiring of a replacement supervisor for the duration of the contract at a cost of 8,500 cedis. 4. Each machine will require 18 hours processing time on the factory equipment. If the order is not accepted, then Sementia Limited will subcontract the factory equipment to Family Limited, any contribution of 70 cedis per hour. 5. The company estimates that the depreciation charge for using the factory equipment to produce the 10 machines will be 4,000 cedis. 6. Overheads are absorbed at a rate of 35 cedis per skilled labor hour. 7. The planning department of Sementia Limited estimate that they have incurred costs to date of 600 cedis. Required: A. Explain relevant costs and state 2 examples of relevant costs in short-term decision making. B. Determine using relevant costing principles whether or not Sementia Limited should undertake the contract. Your answer must include an explanation for the inclusion or exclusion of each of the above points. C. Distinguish between marginal cost and differential costs.
Okay. Okay. So that is relevant costing. Okay. Anything can happen. Sometimes what they will do is that they will give you a question where they will be saying that the management accountant has prepared a statement. So they will give you the statement, and you have to now re-prepare the statement using the principle of relevant costing. Or they can also give you something like that, or something like this that we have over here. Okay, so we are going to be using the relevant costing. What you do for relevant costing is whatever item that you are including, you explain why you are including, and you explain why you are excluding the other ones. Okay, you cannot just prepare the statement and put it over there. The explanation can be the calculation that you are doing to get the what? To get the cost for each of the items. Then you add a small English to it. Okay, so we're looking at question number 2. So question number 2, we have okay, so we have relevant cost statements or statement of relevant costing. So relevant So you'll be bringing something that we call notes, and you'll be bringing the figures over here. So the note is just the explanation that you are giving. So note 1, what item is over there? What explanation that you giving for that particular item to be included over here? So you can just put the items over here and the notes over here and then the currency sign. Okay. So let's go to the first one. You cannot go with a contract without incurring material costs. You are going to be buying material. Okay, so let's come here. They are saying that the company has just received an inquiry about the supply of 10 machines from one of their regular clients. The name of the client is that one has informed the company that the maximum price they are willing to pay is 5,200 per machine. Okay, the order will need to be completed within 2 weeks. Okay, so you can see that they are paying 5,200 per machine. But how many machines will be supplied?
10.
So what will be the total amount that they are going to be receiving there? What will be the total?
52,000.
That will be 52,000. The first thing that you have to know about this question is that everything that they are giving to you over here is per machine, isn't it?
Yes.
And you are going to be supplying 10 machines. So any answer that you are going to be getting should be multiplied by 10. Okay. So if you come to the materials over here, the materials is also per machine. Materials per machine. Okay. So they are giving us information on this one. 10 units of material A. That 10 units is per machine. So the 10 machines will be giving us 100 units. Okay. 10 units of machine A, which is used regularly by the company. The company has 120 units of material A in stock, which originally cost 120 per unit. The replacement cost of material A is 20% higher than the original price. Okay, so this one, whether you have all the quantity there in stock, these are materials that you use regularly for your job. So if you use it, you have to go and buy it and put it there. The 120 that you have over there might be for a different contract. So, but someone brought the contract before that particular one. So you say that you want to use the one that you have purchased now, you want to use it. Then after using it, you have to go and buy. The maximum amount that you can charge the person is what? Is the amount that you are going to be spending to replace the item. So a material that is regularly in use, they are going to be charging the replacement amount. How much is it going to cost them to replace the item if it has been used? The replacement cost is not only the purchase price. Are we going to be incurring delivery costs to bring the item to our premises? That particular delivery cost will be captured as part of the replacement cost, because if not for the buying of the items to replace the one that we have used, there won't be any delivery cost. So it's just like the sellers, those people that you'll be doing deposits. You see, you are going to be paying the money, maybe 20 cedi, 20 cedi, or 200 cedi, 200 cedi. After some month, they will say, the price of the item has increased. And they say you will have to pay something now. You have to you have to do top up. They are using replacement cost because after selling that particular one to you, they are going to be buying the item and replace it. So how much is it going to be costing them to replace it? If not for you, they are not going to be replacing. They should have sold it long time and purchase the item at the original price. But you are telling that they should keep it. So they will now use a cost for you. Okay. So let's come to this particular one. We have the note 1. That will be material A. So we'll be doing material A. We go there and do the note for the material A. So have the note over here. Okay. So we have the first one, material what? Material A. Okay. So what will be the total quantity required to produce all the 10 machines? One machine is 10 units, isn't it? So that will
Yes.
be 10 units multiplied by 10 machines, isn't it?
Yes.
That will give us 100 units. Okay. But this material are in a regular use. So if we use it on the contract, we have to replace it. Why are you replacing? We are replacing because we are using it on the contract. So the replacement is coming as a result of what? Of the contract. So what we do is this particular one will now be valued at what? At a replacement cost. Value of the quantity will now be equal to the 100 multiplied by 120 multiplied by 1.2. Look at it. Do you agree?
Yes.
Yes, sir.
Yeah.
Okay. So the original cost is 120 per unit. But now they are saying that the replacement cost is 20% higher. So just find 20% on the 120 and add it to the 120. In other words, just find 120%. It will be 100% plus the 20%. 100% is the 120, which is the original cost, plus the 20% increment. Put the two together, that will give us what? 120% of the original cost, which is the same as 1.2. Okay, what are you having for that?
144.
14,400.
Okay, 14.
400.
Okay, so what are you going to be writing under that? What are you going to be writing under this particular one?
There is a question in the chat box.
What is the question?
Person is asking if you are supposed to use total cost or cost per unit.
It depends on the contract that you are accepting.
So, senior,
Yes, please.
okay, so you said material A is the regular used by the company. So because of the regular use, if you use the material, you have to replace it.
Yes, please.
And that is the reason why you are including it as a cost.
At replacement cost.
Yes.
Yeah.
So because it is in regular use, the relevant cost will be the replacement cost.
Yes, please. So if you use, you have to buy. Yeah, someone is
Yes.
asking whether relevant cost we find a relevant cost per unit. It depends on the requirement of the question. All relevant costs are calculated on total basis. All relevant costs are calculated on total basis. I will tell you why it should be calculated on total basis. Let's be moving. Okay. Okay, so we are done with the 10 units of the.
So is it because of the supply 10 machine? That's why you multiply the 10 by the 10 units of
Yes,
material
please.
A.
Yes, they say the material per machine. So one machine is, we are using 10 units for one machine. We are going to be producing 10 machines. So that will be 10 multiplied by 10. I hope you're okay with that one now.
All right.
Okay. Material 2. Okay. The reason why I'm solving this question is the material 2. Okay. Isn't material 2? No. It's the material 3, the third one. Okay. Material 2. Okay, 5 units of material B. Okay, the company has 40 units of material B in stock, and it was purchased a few years ago for use in the production of other equipment, which the company no longer produces. If the material is not used in the production of this order, it will never be used again. Okay, it will never be used what? Again. The original purchase price for the items for the unit of material B in store was 190 per unit. Replacement cost of B is 150. The next realizable value for a unit of B in store is 130. So this is the material that is no what? That has no alternative use, but it can be what?
It can be realized.
Or it can be sold. So use the what? So this material now, we are going to be using what? How many quantity do we require to use?
5.
Oh.
5.
Per machine, isn't it?
Yes.
Okay, and we are producing how many machines?
10.
So we need 50.
Okay, we need 50, but we have only 40. It means that we have to go and buy 10, isn't it? We have to go and buy 10, isn't it?
Yes.
Yes.
Okay, so if you are finding this one per unit, if you are finding the cost per unit, how do you go about this one now? You can see that the costs are going to be different for each of the units. The first 9 units, the first 8 units will be valued at what? At 130. And the last 2 machines, the cost per unit will be 150. How can you be producing the same machines and you'll be having different costs per unit? The same machines with the same specifications. You can see that the first 8 machines, which is the 40 unit that we are going to be using, they will be valued at the next realizable value per unit, isn't it?
Yes.
But the last 2 will be valued at the replacement cost because we have to go and buy that one. How can the same machine with the same features be having different costs per unit?
Senior, please come again. I don't understand that the five unit of unit B, that please.
Or the 5 units, every machine we are using 5 units of unit B. So every machine you use 5 units of unit B to produce that one, 5 units of material B to produce it. So for you to produce the 10 machines, you need 50 units. But you already have 40 units in stock, which has no alternative use. But if it is not used for the production, you can sell it at 130 per unit. So if you want to use it now, it means that you are going to be losing the amount that you are going to be what? You are going to be realizing from the sale of the unit. So the relevant cost over here becomes the opportunity cost of what? Using the what? The quantity that you have instead of what? Selling it. So the first 40 units will be able to produce what? 8 machines, because one machine is 5 units.
Right.
So 8 machines will give us what? 40 units. Then you need additional 10 units to produce the last 2 machines. The 10 units you have to go and buy it because you don't have it. So you'll be buying at what? At the replacement cost or the current market, the current price of the item. And that will be 150. So some machines with the same features are valued at 130 and one is valued at 150. Why? Are you producing some of them in Togo and some of them in Ghana? No. Contract relevant costing are mostly done at what? At total basis. But the question that you have been seeing, they will just say the company want to accept a contract. Then they will give you the value or the quantity of the contract. And they say the company want to accept a contract up to this particular one. The price that you are looking for is not per unit. It's the total amount that you are going to be using for the contract that they want to accept. Okay, so let's come to the note 2.
So yeah, so it means we multiply the 5 unit by the machine to get the 50. Eh?
Yes, please.
Oh, okay.
I hope you are fine with that
Okay.
one now.
Yeah, because as you mentioned, the 50, I was looking at the 50 that you mentioned. So I just multiply the 5 units by the machine, the 10 machine to get the 50.
So I wasn't writing the 50. So you are hearing the 50 that I was mentioning. So you cannot see. I didn't write.
I was just thinking how we got the 50.
Don't worry, let's move on. Don't worry. So you are hearing the 50 that I was mentioning. No problem. Don't worry, everything will be fine. So what are you going to be writing? You have to add a note to the 1,400 over here. And that note we have actually said something about that note. But say it again. What are you going to be what is the reason for valuing this as what? At the replacement cost. You have to add the reason over here. What are you going to be writing to the calculation that you have done?
Cost material A are in regular use. The
Okay.
relevant cost will be at the replacement cost.
That is it. That is all. So because these material are in regular use, if they are used on the contract, they must be replaced at a price of what? So you do your price, the price of 120 multiplied by that particular one. Okay. So let's come to material B. Okay, let's come to material B. So the material B, you do your workings all right. Then you come and write why you are including or why you are valuing it at those figures. So we have material B. We have material B to be, so material B, the first 40 will be valued at what?
130.
130.
Okay, so those ones, assuming they don't have net realizable value, would they be having any relevant cost?
No.
Okay, so it means that it's surplus. Okay, if you don't use it, you just put it there and it will spoil. You cannot do anything. Okay, so what will happen over here is that the first 40 units will be valued at 130, and we have to go and buy the remaining 10 units, isn't it?
Yes.
And that will be done at the replacement cost of 150. How that is cool.
So 1,005 plus 5,200.
So
This 700.
6,700. No, the top rather is 5,200.
5,200. Okay, 5,200 be 1,500.
6,700.
6,700. Okay, so what will be the English that you are going to be adding? Okay. So you explain, you do the workings and still add the explanation here. What are you going to be adding?
So material B, because it has no other use, so the first 40 will be valued at the net realizable value. And then the extra 10 that will also be valued at the replacement cost.
Okay, that is also not bad. That's also not bad. But do you have somebody who wants to say that in a different way?
Okay, Sneha.
Yes, please.
Okay, because material B has no other use but it could be sold for 130. The relevant cost is 130, but it has a limit of 40 units, which is not up to the 15 units that material B requires. So the 40 unit will be realized at 136, which will give it the 5,200, and then the remaining 10 will be at a current market cost, which is 150 per unit.
Okay. That is also not bad. That's also not bad. That's also not bad. That's also not bad. Okay. That's also not bad. Okay. All right. So yes, you see sometimes to how to put the answers to is also one of the things that normally take our time. Okay. You are not going to be having a very short something that you say in a very short way. And as you are writing, you are thinking, and the time is also going. Okay. The company what? So I will be writing something simple over here. Okay. Okay. 50 units of material, or the company requires what? 50 units of material B to be able to produce what? The 10 machines, isn't it? The 10 machines, to be able to produce the 10 machines. However, there are 40 units of material B in store, which has no alternative use, but can be sold at 130 per unit. $130 per unit. $130 per unit. The 130 per unit, thereby making the entity loses 40 multiplied by 130 if the 40 unit is used on the contract. So the relevant cost for the first 40 will be the 40 multiplied by that one. So the entity will need additional 10 units. So relevant cost for that particular one will be 40 multiplied by 130. And that is the one that we have over there. Okay. Additional units of 10 will be purchased at what? At 150, thereby giving us the value of this one. So actually something around this one. Okay, that would be cool. But this also plenty. Okay. The contract requires 50 units of what? Material B. Okay, the existing contract requires 50 units of material B. The 50 you can do 10 multiplied by 5. However, the entity has 40 units of this material in store, which has no alternative use but can be disposed. So the relevant cost over there becomes the net realizable value. And the entity have to purchase additional 10 units to be able to carry out the contract. So the shortfall of 10 units, that will now be purchased outright because we don't have any. That will be making the relevant cost to be that particular amount. Okay. So what I've written over here also is kind of it's kind of plenty. Yeah, I saw a hand up.
Hello, sir.
Yes, please.
Sir, please, is the explanation supposed to be short or long or short and relevant?
Is the explanation supposed to be what?
Is it supposed to be a lengthy one or short one?
We are having different students coming from different places, so they cannot be explaining one point in the same way. Okay, at the end of the day, it should be explanation. There should be explanation.
Okay, sir. Thank you.
Okay. So depending on the kind of student that you are, if you are a lazy student, then it will be very simple for you. If you are a student who likes talking, then it will be very plenty for you. But at the end of the day, there should be explanation to why you are including that particular cost. Okay, so this is not actually the reason. Okay, the third material is the reason for this particular one now. Okay, antivic. Okay, 3 units of material C. This type of material is regularly used and usually costs 85 per unit. However, the company current supplier earliest delivery time for this material is in 3 weeks time. How many weeks is it taking us to what? To complete the contract?
2 weeks.
2 weeks.
2
Okay.
weeks.
So
2 weeks.
it means that we cannot get this particular within that. We cannot replace if we use the current one that we have now. We cannot replace it within the 2 weeks, isn't it? Okay. So 3 units of material C. So we are going to be using 30 units in all. This type of material is regularly used. So if we use it for the contract now, we should be able to replace it. But they are saying that our usual supply, the lead time is what, 3 weeks. So if we use it for the contract, we might not be able to get a replacement for those ones from our regular supplier to replace the one that we have used. But let's be reading. Okay, an alternative supply could deliver immediately, but will charge 90 per unit. Okay. The entity has 600 units in inventory, but 580 are needed to complete order existing order in the next 2 weeks. Very interesting. So if you are using the current one that you have, if you are using all the 30 now, you will not get what? You will not get that particular one, but you have order that you are going to be executing in the next 2 weeks again. You cannot replace the portion that you have used. Okay. Are needed to complete the existing order in the next 2 years. The remaining 20 will not be needed until 5 weeks time. The remaining 20 will not be needed until 5 weeks time. A very interesting one. And this is the reason why I'm solving this question. It's not for any of the thing that you are saying. It's because of this one. Currently, how many quantities of material C do we need to be able to complete the contract that we have accepted?
30.
We need 30, isn't it? Okay.
Yes.
Yes.
Currently, they are saying that they have 600 units over here, isn't it?
Yes.
But 580 of that will be used while we are working on the contract also. 580 are needed to complete other existing order in the next 2 weeks. So we are going to be adding this order to the other ones. Okay. So 580 will be there, and we need 30 units again, isn't it?
Yes.
So what will be the total requirements? That will be 610, isn't it?
16. Yeah.
Okay. That will be 610. So the 580 will be used on different
Plus
contracts. So we have only 20 left. So we need additional 10. Let's come here. They are saying that alternative supply is there to what? Is there to give
supply
us
in 3 weeks time.
okay, no. Our main supplier is a 3 weeks time. Our main supply is a 3 weeks time, isn't it?
Yes.
Okay, so it means that if we are using all the 30 out of the 600, we cannot be able to get a shortfall of 30 to what? The shortfall of 10 to be able to complete the existing contract that will be done in what? In 2 weeks' time, because our supplier will be supplying to us in 3 weeks' time. So if you are using all the 30 of the existing ones that you have, you will not be able to get the shortfall of 10 from your main supplier within the 2 weeks that you are going to be completing this particular contract. So 580 over here is out of this one because you are going to be using this to complete the contract within the same period that we are carrying out the new contract. So 20 will be left over here. So we'll be having 20 after the 580 has been used. Okay. To complete the existing order in the next 2 weeks. The remaining 20 units will not be needed until 5 weeks time. So after using the 580 over here, 20 will be left. But they are saying that the 20 will not be needed until the 20 that will
5 weeks time.
not be needed until 5 weeks time. So it means that if we use the 20 on the contract that we have accepted, we can actually get the supply from our main supplier because it will take the supplier 3 weeks. So he can supply before we even need the 20. I hope that explanation is okay. Okay. So this 20 that we are going to be using over here will be bought from our main supplier at how much? Because he can actually supply before
85.
that will be 85. So this particular will be needed in 5 weeks time. So that particular quantity can be taken from our
Replace.
current supplier because he's going to supply in 3 weeks time. So he can supply before we even need this one. How do we go about the remaining 10?
That will be the 96.
So we have to buy the additional 10 from From the current supplier, isn't it?
Yes.
Okay. So what you do over here is this one. Okay. It's a very exciting one. Okay. So you come here and you come to material C. material C. So you have 600, you are using 80 on existing contract, remaining 20. Okay, then this 20 will be needed in 5 weeks' time. So you can use it now, and your supplier will give you this item in what? In 3 weeks' time. So the first 20 will be, so the cost, which will be, we are going to be buying from our current supplier. Okay, current supplier, that will be 20 multiplied by 85. Okay, 85. And that will be giving us how much?
1,700.
Okay, we'll be having 1,700. So 20 multiplied by 85, we are having 1,700. So the 10 now, we now have to have from the alternative supply, isn't it?
Yeah.
Okay, because the contract that we are currently doing now will be for what? Will be for 2 weeks. So we have 580, we have only 20. We cannot wait for our main supplier to give us what? The 10, additional 10, no, because we will even complete the contract before he will even supply. So we have to find alternative source for the remaining 10. So we come here, we have 10 units multiplied by 90. And that will give us 900, isn't it?
2,600.
2,000 what? 600. So this is a very simple one. So you have 600 now. You are using 580 has already been what? 580 has already been taken. So you have 20. This 20, you will not need the 20 until 5 weeks time. So it means that you can use the 20 on the contract now. But will your current supplier be able to supply the 20 before the 5 weeks time? Yes, he will supply within 3 weeks. So we can be able to get the 20 from him before the what? Before the 5 weeks time. So we have to buy the 20 from him because this material is in regular use. So we have to replace it at 85. But the remaining 10, we are completing this particular contract within 2 weeks. So it means that the remaining 10, we have to go and look for somewhere. And the person is charging what? 90. So that will give us a total of 2,600 for the material. So we have material C, load this one. We have 2,600. Okay. What are you going to be adding to this one? If you are the one doing it in the exam hall, what are you going to be adding to this?
Hello, sir.
Yes, please.
Can you hear me?
Yes, please.
Okay. So for the notes, I would be saying that since the 20 units we need will be supplied in 3 weeks' time, and then the 20 will be needed for the regular production in 5 weeks' time, we can say the relevant cost we are incurring for the 20 units is just the replacement cost. That's going to be in the 3 weeks' time. But the extra 10 we need to complete this existing specific contract, we need it immediately. So we have to purchase it at the price the immediate supplier is willing to offer them to us. So that 10 is going to be at 90 cedis each, making our total cost for material C to be 1,700, 2,600, sorry.
Okay. Okay. All right. No problem about that one. Do you have anyone who wants to say it in a different way? Benjamin, are you not going to try?
Okay, senior.
Yeah.
Okay, material C is a regular use material, which means if you use it, you have to replace it.
Okay.
So, but material, the entity has 600 as inventory. So, but they need 580, which means material C that we need 30 units to produce the 10th machine.
Yeah.
There's a need to get additional 10 units. But material C, the supply have to be in 3 weeks, and then the contract is within what 2 weeks. The entity have a contract that existing contract that they need to do that is within 2 weeks. So if that means the 20 that is the extra one will be bought at the normal supply, which is 85 series, and then the other 10 units will be bought at the alternative supplier, which is 90 series per unit.
So all these things, you are going to be saying all these things within the 36 minutes that you are using for this question.
Hey,
So I was
You will
when you
summarize
get
it,
there, the
isn't it?
English will come.
I was
When you get there, the
summarizing
English will come.
Okay.
within 10 seconds for it.
Okay. No problem. So you just write something over there. But the thing should be about a reason. Okay, but let me bring this one. The entity needs what? We need 30 units of what? Of material C to produce, isn't it?
Yes.
Yes.
Okay. 20 units of this 20 units of this particular material is already in what? In the store, isn't it? Okay. Which will
Yes.
be needed in what? Which will be needed in 5 weeks' time. Which will be needed in 5 weeks' time. So if used on a contract, can be gotten from our alternative supplier. So 20 units of this material will be bought from what? From the alternative supplier. And the additional 10 units will be bought from what? From the alternative supplier. So the entity needs what? 30 units. 20 of this is in stock. This material is in regular use. So 20 of this is in stock. If the 20 is being used, the 20 can be replaced from what? From the current supplier at 85. Additional 10 will not be what? Cannot be obtained or cannot be purchased from what? From the current supplier. So the entity has to use alternative supply for that particular one. And that is also valued at the alternative price of the item, 10 cedis. Okay. 90 cedis multiplied by the 10 units. Okay. So that is it. That is it. But whatever be the case, just you didn't just stand up and say you are doing 20 multiplied by 85, 10 multiplied by 90. Why are you doing that? That is what they are asking you to say. Why are you multiplying by 85 and multiply by 90? Why are you doing that? There's a reason for that. Just state the reason under the computation. Okay. So we have the 2,600 now. So let's go to this particular one now. Let's come to the issue of labor. Please, you cannot have relevant costing question without what? Labor and material. No, it's not possible. It will always be about labor and material and other variable costs or other fixed costs that are specific. So you have to understand if it is a material, how do we go about it? The material is regular. If it is in regular use, after using it, you have to replace because you'll be getting a different contract. If it is not in regular use, do you have alternative use? If there's no alternative use, can you actually sell it? If there is no scrap value, it means that that material will be worthless if not used for the contract. So if you don't use on the contract, it will just be there. It will be nothing. So the relevant cost is zero. But if you can actually sell the material that is not in regular use, if you can actually sell it, then if you use it, you'll be losing the amount that you are going to be receiving. So the relevant cost will be the what? Will be the next realizable value. Sometimes there can also be a material that the supplier will be saying that they don't sell the material in pieces. So they sell the material in what? In bulk. And if you buy the material, the remaining ones, you cannot use it for anything. In that case, the total amount that you are paying for the material becomes a relevant cost. If the remaining material cannot be used for anything, you need 280 the supplier is saying that he can only sell, the minimum amount that he can sell is from 300. You are going to be using 280. Do you have any alternative use for the 20? If there's no alternative use, then it means that the relevant cost is all the 300. Because not for the contract, you won't buy the what? You won't buy the 300. But if the what? If the remaining 20 has alternative use or has a scrap value, then you can just subtract the scrap value from what? From the total amount that you are paying. Or if it is having alternative use, it just means that, okay, yourself planning to go and buy that material, yourself, you are planning to go and buy that material before you bought what 280 for the contract. So you just use the 280. You just have to pay attention to these 4 issues under the material. These are the 4 issues that will be coming there. Let's count the labor hours per machine. Labor hours per machine. 12 skilled labor hours will be required. Skilled workers are paid 20 Ghana cedis per hour and are part of the payment workforce. At present, there are 125 pay surplus skilled hours per month. Skilled workers are paid time and half for overtime. Okay. How many hours do we need to be able to produce this particular contract?
120 hours.
Okay, but they are saying that currently they have what? Do you know what they are saying? The surplus hours. The pay surplus hours. Do you know what they are saying then?
Idle time.
Okay, that is the ideal time. So you come to the 4 over here. So you have the skilled what? The skilled workers over here. Okay, they have the skilled workers over here. Okay, so we look for the total hours required. Very important. Total hours required for the contract. That will be 10 machines multiplied by 12 hours. Multiplied by 12 hours. Okay, so that will give us 120 hours, isn't it?
Yes.
Okay, what is the idle time?
125.
Okay, idle time, 125. Okay, would there be any relevant cost here?
No.
Okay, relevant cost is what?
0.
Okay, relevant cost is 0. Since what?
Yes, idle time
That
is
is
5.
The idle time is higher than what?
The total of 5 hours.
Okay, it's higher than the contract hours. Okay, it's higher than the contract hours. So currently, you are paying people for 125 hours for no job done. So if they are coming to use 120 of that, it's just like they are not working for 120, you are still paying them. So there's no relevant cost. You are not going to be incurring any additional cost as a result of using them on a contract because you are currently paying them for that hours that they are going to be spending. So whether the contract is accepted or not, you will still pay that particular amount to them. But if the ideal time should be 120 and the total hours required is what? Is 125. What would be the relevant cost there?
5 hours.
That would be 5
5
hours.
hours by the
Okay, multiplied by the rate per hour, isn't it?
Yes.
Don't use the overtime. The 5 hours is not an overtime, unless the question is saying that it's an overtime. Okay, it means that they will just work for additional 5 hours. We are paying them 120, so they have to work for 5 hours, which we have to pay them. So they are using 5 hours now on a contract. If not for the contract, they won't work for that 5 hours. So you have to pay them. Don't use overtime unless the question is telling you that the people are going to be using what they are going to be working overtime, or they are saying that the workers are now what fully engaged. So the contract they'll be working for 20 hours. If you are fully engaged, what it means that there is no spare time on the current workforce that we have. So any hours that they are going to be working will be an overtime. Okay, but this case, if it should be 120 against 125, they work for 5 hours. That 5 hours, are we saying that it's an overtime? We don't know. Okay, so the question has to tell you that 5 hours is an overtime, but currently there will not be any relevant cost over here. But what you do is, although there will not be any relevant cost, you bring it over here and push dash. So you have the skilled labor over here as workings for, then you put dash over here. Okay. If it will not be part of the cost, please still bring the dash. You are not adding. So it means that it's not part of the cost. But just bring it and add the note so the examiner can go there and read why you are writing 0 for that particular one. Okay. Let's come to the, okay, 22 unskilled labor hours will be required, and unskilled workers are paid 15 per hour, are employed on casual what basis. What does it mean?
Okay, so since these are casual workers and they are not permanent staff, whenever we need a contract, whenever we have a contract, that's when we actually employ them. And now we have a contract for 2 weeks. So since they are going to work for us during that time, we have to actually pay them, and it's going to be relevant.
Okay. Any other opinion?
So the contract will require both skilled and unskilled labor hours, but then that of the unskilled, we need 22 unskilled labor hours, and this will be paid at 15 per hour.
Okay. Whatever you are going to be saying, you'll be getting the what? You'll be doing 15 multiplied by 220, isn't it?
Yes, sir.
Yeah,
To
yes,
get to get a relevant cost, isn't it? That is
yes.
fine. All right. But the reason why we are going to be doing this is that these people will only be engaged as at when the need arises, isn't it? Yes. So they are not part of the workers. So if we have any contract, that is why we are going to be bringing them. Okay. So these people, whenever we have any contract, then we bring them. We bring them whenever we have a contract. So since we have a contract, we bring them now to come and work. So we are bringing them because of the contract. So we just employ you as at when your service is needed. So since they are not workers, you have to bring them for this particular contract at 15 cedi, and a machine will be requiring 22 hours. So for the 10 machines, that will now give you 220. So okay, so we have the unskilled labor over here will be total hours required. That will give you 22 multiplied by the 10. That will give us 220 hours. So the relevant cost over here will be 220 multiplied by 15, isn't it?
Yes, sir.
What are we having?
3,300.
3,300. Okay. The note that you are going to be adding are these workers are only engaged when there's a contract. They are engaged on contract basis. So they are not permanent workers. Okay, they are part-time workers. So you only bring them when there's a contract. And you pay them for the work that they have done. So these people are coming in for what? For contract. So they will be engaged purposely for the contract. Therefore, the relevant cost will be the total hours that they are going to be using by the what? By the rates. So we have the unskilled labor will be this one. Then we have 3,300. Then you go and add that one now, and we actually move on. Okay, let's come to the supervisor now. Okay, let's come to the supervisor now. A supervisor with the necessary experience in the production of similar machines, who is currently paid 5,600 per annum, will be transferred to the job. This will necessitate the hiring of a replacement supervisor for the duration of the contract at a cost of 8,500. What is the relevant cost over there?
8,500.
8,500.
Yeah, is the cost of replacing that particular person. If not for the transfer of this particular supervisor to the job, would there be any what? Would there be any different worker coming in?
No.
Okay. If they are not bringing any worker, if they are not bringing any person to come and replace this person, then this will be the relevant cost now. Okay, this is how we go about the relevant cost. This one is per annum, isn't it?
Yes, sir.
This one is per annum, isn't it?
Yes.
Okay. So if you want to find per week, that will be divided by 52. Is that correct?
Yes, sir.
Okay, what are you going to be getting?
1086.5.
Okay, 1086.5. Okay, since this person will not be working for 2 weeks on the main job, okay, the salary that will be paid to this person will be transferred to what? To where he's working now. Okay, so if no one is coming in, the person will not be using 2 weeks at the normal place. So that 2 weeks will be transferred to where the person will be working at. Okay, so that will be 1086.2. But is there any contribution that the company will be losing as a result of transferring this person? Then you add the contribution loss, which is the opportunity cost to what? To the normal salary for the 2 weeks. That will be the replacement cost. If you are not going to be what? If you are not going to be replacing the person. So if you're not going to replace him, it's a worker. You are going to be paying the person based on the number of hours used. So if you use the hours over here, we pay you for the work that you have done there. But you are now using 2 weeks somewhere. So that 2 weeks somewhere that you are not using it on the what? On our normal contract. So we cannot apportion that particular cost to our normal contract. So the cost will be charged to where you are working, where you are using the hours. So we have actually taken you to be supervising our contract. Now they have taken you to a different place and you have used 10 hours. Those people will pay you for the 10 hours that you have used over there. So that cost will be transferred to that particular place. As you are living there, is there any contribution that we are losing? Is there any contribution that we are losing as a result of you moving from this place? So the people will now pay the cost for you and also the benefit that we are going to be getting if we are what? If we are allowing you to go. Okay, that is how we go about it. But this one, there's a replacement. So if you are going to be replacing the people, it is going to be the replacement cost. But sometimes they can give you so many options, whether they should replace, whether they should transfer the person, or whether they should make the person work for overtime. You do for all these three options and pick the least cost. So they can say either the person, whether we find replacement, the replacement will be 8,500, or the person do what we call the overtime. So we calculate the overtime cost also. Then we calculate what? The amount of what? Having a different person and also transferring you from that particular side without the what? Without replacement. We find the cost that the entity will be losing as a result of that one. Then you pick the least one among them. So it's not automatic that the relevant cost will always be what? Will always be the replacement cost. They can give you options that the entity is going to be what? The entity is thinking about finding a replacement at a cost of 8,500 or allowing this person to what? To carry out or to now work for overtime. So you calculate your overtime and compare with the replacement. You pick the least cost. But in this case, the only cost that we are going to be incurring is the what? Is the replacement cost. Okay. So we come to the cost of the supervisor. So the supervisor. Okay. So the relevant cost is what? The relevant cost is 8,500 since the entity would have to incur. Okay, since that's the cost. Okay, let's forget about since that is the cost the entity will incur You incur to replace the what? The supervisor. What it means that if the supervisor is not transferred, there will not be any cost of that one. So we are incurring that cost as a result of the transfer. So we have the supervisor here. Supervisor to be 6, and that will be 8,500. Okay. So let's come to this one. Okay. Each machine will require 18 hours processing time on the what? On the factory equipment. Each machine will require what? 18 hours processing time on the factory equipment. If the order is not accepted, then Senecia Limited will subcontract the factory equipment to Femin Limited any contribution of 70 per hour. Any contribution of 70 per what? Per hour. Okay. So if we are using this particular machine now, for the contract, it means that we are not going to be hiring this particular machine to anyone again, isn't it? Okay. So you look at the current contribution from the hiring. Okay. So they are saying that each machine is going to be requiring what? Each machine is going to be requiring 18 hours processing time on the factory equipment. So how many hours will be used on the factory equipment if you want to complete all the 10 machines?
180
Okay.
hours.
180 hours. Okay. So we have the machine over here. So you have the machine. So I'm sure this will be workings. Okay. 5 and 6. This is 5. This will be 6 and this will be 7. So machine. So we look at the time required for the 10. Time required will give us 18 multiplied by 10 machine, isn't it?
Mm.
Okay. So they are saying that we are going to be using 180 hours. Okay. This 180 hours that we are going to be using, they say that if the factory equipment is not used, what are we going to be doing?
We're going to sublease it.
At what? The thing is giving us a contribution of what?
Of 70 cents per hour.
Okay. So if you are using on the machine now, are you going to be getting the contribution again?
No, sir.
So what will be the relevant cost?
Relevant
No
cost.
opportunity cost.
So the relevant cost over there will be the 180 hours multiplied by what? And we are getting
12,600.
12,600. Okay. So opportunity cost of using a machine, I will tell you a different one now, 12,600. Okay. Sometimes they can give you they can say the machine running. If you want to run the machine, you are going to be having the machine running cost. The machine running cost is different from the depreciation of the machine. Depreciation, whether you are using the asset or not, since the asset is ready for use, the asset will start depreciating. If someone has constructed a structure for you and the structure is ready for use, you haven't moved into the structure will start what? Spoiling. Although nobody is there, but it will start spoiling. Okay, so for depreciation, whether you are using the asset or not, depreciation is going to be what? Yeah, if the asset is 50 years, whether you use it or not, yeah, after 50 years, it will start misbehaving. Okay, it will start misbehaving. That's why a tin tomatoes, if it is ready for use, and they say that it will last for 2 years, whether you touch it or not, after 2 years, it will spoil. So it doesn't mean that you have to use it before it will be what? It will be spoiling or whatever. No. If it is ready for use, and you have put it there without using it, after 2 years, it will spoil. Okay, so if it should be, a question can give you the machine running time. So machine running time is the person who is going to be incurring the machine running time. So if we are having a machine running time, then it means that the machine running time is being incurred by whoever is using the machine. So you'll be taking you are now going to be incurring the cost of running the machine at the same time what the contribution that you are going to be losing. So the relevant cost will be the machine running time because you incur the machine running time. At the same time, you are going to be what? You are going to be losing the contribution. So you put the two together. But this one, we don't have information on the machine running time. They are only giving us what? The contribution, the cost that we are incurring on the machine from the amount that we are receiving, and they are giving us the net amount that we are what? We are actually what? We are actually what? Incurring on this particular machine. Okay, so that will be 180 multiplied by 10 machines multiplied by 70. The company estimate that depreciation charge for using the factory equipment to produce the 10 machines will be 4,000. Depreciation, relevant or irrelevant?
Irrelevant.
Irrelevant.
What are you going to be writing?
Depreciation is a sunk cost.
Hey,
Okay, so sir,
yeah.
first of all, depreciation is a non-cash item. And that's the second thing too is that whether we attain this contract or not, our machine is going to be depreciating. So this depreciation cost is not arising because we are accepting the contract, but it's already there. So we don't allocate it to the total cost of this contract.
Okay, I will take the first one. Okay, and the second one altogether. But just stick with the first one. For relevant costs, we use cash flows, we use incremental costs, we use variable costs. Okay, so depreciation is a non-cash what item. Very simple. We are not including the depreciation because depreciation is a non-cash what item. Depreciation is a non-cash item. Overheads are absorbed at a rate of what? 35 Ghana cedis per skilled labor hour. Relevant or irrelevant?
Irrelevant, sir.
Why?
These are fixed costs.
Fixed costs.
Okay. So these
And
are
fixed
fixed costs already. That is all. Just is that what you are going to be saying? These are fixed costs right there.
Oh no, sir. These are fixed costs, meaning that whether we take this contract or not, they are going to be incurred. So they are not there for the purposes of this contract.
Okay. So overhead is irrelevant cost because it's not an incremental cost. It's a cost that will be incurred anyways if the contract is being accepted or not. Okay. So we use if it's a fixed cost, it will be incremental fixed cost. The planning department, okay, the planning department of Semeshia Limited estimate that they have incurred to date 600 Ghana cedis. Relevant or irrelevant?
Irrelevant, sir.
Why?
Some costs.
This
Okay.
planning department has already incurred a cost whether we are going to take this contract or not. So
Okay.
they incurred it just to plan. We might
Okay.
take the contract, we might not take it.
So that is a sunk cost. The planning cost is a sunk cost. Okay. So let's put the total cost together now. Then we now tackle what they are going to be asking us there. How much thousand?
39.
That's 9,000.
Yes.
Okay. The question is whether they should accept the contract or not, isn't it?
This is accept because those are the costs.
Okay. So why will you tell them they should accept? How much are they receiving from the sale? How much will be the what?
Hey,
What will be the selling price? Or what is it? Let me just say the
Selling
contract
price.
price.
So the selling price is 52,000,
So the
and their
contract
total
price
relevance
will be,
cost is 48,100.
so we have 52 multiplied by 10. That will give us 52,000.
Yes,
Then we
we have
have the
48,000.
it's 48,100.
48,100.
48,000.
100.
100.
Okay, 48,100. So the relevant cost or the contract cost is what? 48,000. Okay. So 48,100. What is the difference?
Difference of 3,900.
3,900.
900.
900.
So should they accept?
Yes. This is because the price is higher than the cost we will incur for it.
Or they will make a contribute, they will make a positive, or they will make a profit of 3,900 that will be added to their existing operations. Okay, the person that was asking for the relevant cost per unit. Okay, you can find the relevant cost per unit after doing everything over here. Okay, so this cost will now be 4,800 divided by 10, isn't it?
Yes,
Yes.
that'll be
That,
4,800.
that will give us for this one now, isn't it?
810. Yeah.
Okay, so you can find this one now. So you can find your total cost and divide it by the unit. But if you want to find it per unit, please, some of them will not give you the exact answer, because you can see there are situations where some of the machines will be valued at 130 and the other ones will be valued at 150 because of that material now. So you can find the total cost and now divide by 10 if they're asking you to do it per unit. Find the total cost and now divide it by what? By the number of units that you are producing. So they should accept the contract. Okay, but we didn't tackle on some questions here, a theory part. What is a relevant cost? Charles, what is a relevant cost?
It is a cost incurred as a result of taking a decision.
Okay, 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 okay. No problem. If you say that one too, no problem. That is a relevant cost, a cost that you are going to be incurred as a result of what? Taking a particular decision. Okay, a cost that is
Example
specifically
would be
associated with what?
cost.
With a particular decision, a cause that you cannot avoid when a decision is taken. Okay, what are the examples of relevant costs in the short-term decision making?
Health opportunity costs.
Okay,
Avoidable
Have
costs.
replacement
Avoidable
costs.
Incremental cost.
okay, okay. So if they ask you write those things,
differential cost.
okay,
Yes, sir.
differential cost. Okay, no problem. Marginal cost is also, or marginal can be the same as the avoidable one. Okay, mostly we use the direct labor and those ones to be the avoidable cost. Distinguish between marginal cost and differential cost.
Yeah, marginal cost is consider only the variable cost, but the differential cost consider the both variable cost and fixed cost.
Okay. Okay, marginal cost
Marginal cost
considers
is
only the variable cost. That is fine. But the differential considers both the marginal and what?
The fixed cost.
No, it will not, you will not just consider that one. You only consider it if the cost is going to be something that is going to make a difference. What do we mean? If the fixed cost is going to be increasing, okay,
Yes.
if you are currently incurring 5,000 for a parking space that you are renting, now you are buying an additional car. Okay, you are buying an additional car now, and they are now increasing it to 7,500. You can see that as a result of the additional car, there is a difference in the cost of what? 2,500. There is an incremental cost of what? 2,500. Okay. Okay. So there's a differential cost or the incremental cost of what? Of 2,500. So if you say consider both in the fixed cost, what if the fixed cost is what? Is fixed. There's no increase in it. Then I hope you are getting my point now.
Yes, please.
Okay. So yeah, that will not be bad, I think, but the fixed cost, you should be very specific with the what? With the fixed cost. If the fixed cost is going to make a difference, if the fixed cost is going to make a difference, then it will be considered together with what? Together with the marginal cost. The marginal cost is just calculated on the direct cost. So the marginal cost is just the what? It's just like the prime cost. But the differential cost is any cost that is going to make a difference if you want to take certain decisions. So if you want to now, you are deciding on buying a Benz and Toyota. what is the difference over there? What is the difference in the cost that you are going to be incurring? Okay, we can say that is a differential cost. So what is the difference over there? That can also be a differential cost. Okay, although what you have said is not bad, but the fixed cost should be polished. Okay, consider marginal cost at the same time incremental what? Fixed cost. Okay, but if the fixed cost is increasing, it will not be captured in the marginal cost. It will not be captured in the marginal cost. But if the fixed cost is increasing, it will be captured in the differential cost. It's a cost that is making a difference as a result of you undertaking a particular decision. Okay, I hope that is actually cool. Okay, let's see what we can do over here. Just let's do something on break-even analysis. That's the break-even analysis. Which one should I pick? Let me see. The break-even analysis. Okay, this is how they have been from the beginning of the short-term decision making. This is how they have been setting the question where they will give you some strategies. Okay, they will give you options and they will ask you whether the entity you should evaluate the strategy and advise them which of them they should use. Okay. Yes, just let's do question number 4.
Okay, so question number 4. Wasiako Limited manufactures high-quality coffee biscuits that are sold to hotels and restaurants in Koforidua. 2 months ago, it had prepared a budget for the forthcoming financial year. Details of the budget is presented below. So we have sales, we have direct materials, labor, variable overheads, fixed overhead, and with total cost, and having a profit of 947,400 Ghana. The budget have been prepared on the assumption that sales will be 800,000 packets of biscuits. However, due to economic conditions, the sales forecast for the year is now 720,000 packets of biscuits. It is expected that selling price per unit, direct cost per unit, and variable overhead cost per unit will not change from those budgeted. It is also expected that fixed costs or fixed overheads will be the same as those budgeted. Management is now considering a number of options so as to improve profitability for the forthcoming financial year. Option 1, decrease the selling price by 20%. It is anticipated that this would increase sales volume by 25% on the forecast sales for the current year. Option 2, decrease all variable costs by 10% and decrease fixed costs by 10%. This is not expected to have any impact on the sales level. And option 3, decrease the selling price by 10% and decrease fixed costs by 5%. This is expected to increase sales volume by 25% on the forecast sales for the current year. Required. A. Calculate the expected profit for the current year, bracket forecast sales. And B. Based on the forecast activity for the year, calculate point 1, the break-even point in packets of biscuits. 2, the margin of safety in percentage terms. And 3, the sales revenue required to earn a profit of 1,440,000. And C, evaluate the profitability of the 3 options and recommend the option that Wasiako Limited should adopt.
Okay, so this question is all. So the only question that is a question that bringing over, which is a new question, is a question number 1. So the question that we have solved is the ICA question. I'm sure the one that we are going to be solving now too is an ICA question. This is a new syllabus, and they may find it difficult to go and set questions. They can just pick any of these ones and modify them. Okay, in a very way. Maybe they might not be the same question, but maybe it will take the same format, but they will change the figures. Okay, so they are saying that we should calculate what? We should calculate we should calculate the expected profit for the current year, which is the forecast sales, isn't it?
Yes, sir.
Okay. So let's come to, they are saying that this estimate is based on what?
Assumptions that sales will be 800.
600,000.
So this is based on 800,000, isn't it?
Yes, sir.
Yes.
The forecast is now what?
720,000.
Okay. So I will tell you how you can do this one in a very simple way. You know that the variable cost and the selling price will vary on the number of units that you are selling, isn't it?
Yes.
Okay, so you can actually flex this one. The sales will be based on units. The direct material will be based on units. The direct material will be based on units. Variable overheads will be based on units. But for the fixed cost, whether you are producing less or not, you can still incur the same what fixed cost. So you can actually flex the variable element over here, and you maintain the fixed cost. Or you can find the cost per each unit, the cost per the packet that they are selling, because 600,000 is for 800. So what would be the selling price per packet? If you do that, you have to come and multiply by the unit again. That will be taking your time. You do that for only the break even. So we are going to be doing this one by using the flexible budget approach. Okay, so let's come to the A over here. We have the statement of profit. Statement of profit based on
The current.
forecast sales. Based on forecast sales. Charles, are we doing PSA today?
Yes, sir.
I have
6
to
p.m.
send
today.
I have to send it to tomorrow. Let's start tomorrow to Thursday so that we can finish FM and then the PSA so after the class I will just communicate that. Okay. The questions are not ready. So what are you coming to learn? Okay. So let's come to this particular one. So let's come here. So we are going to be having the sales now. We prepare this one based on what? Flexible budget. So let's come to the sales over here. So this will be 720,000 divided by 800,000 multiplied by 6 million. Do we agree?
Yes, sir.
Okay. How much are you getting?
$5,400,000.
Okay, so let me keep 3 zeros at the top. 5,400, isn't it?
Yes.
So
Yes, sir.
I'll have direct cost over here. So I have material. Material we can flex it because it's a variable cost. So material cost will be 720 divided by 800 multiplied by how much?
2,080.
2080,000.
2080,000. How much are we having?
1872.
18.
72.
Okay, 1872. Let's come to labor.
Yes, sir.
Yeah, 720. See, are you talking to me?
No. So what are you doing with the link? What are you doing with the link?
Which of them? Or it's not me?
And I said dial the code. Didn't you read my message well? I said just dial the code
Hey.
and do it. No. I think the message I stated it. So
Yeah,
just
me.
dial the code. Uh-huh.
So he's not talking to us.
No, sir.
So you have forgotten that the mic is on. Okay, it's all part of the pressure. Labor cost is what?
1044.
1160,000.
1,1.
60,000.
Okay, so what are we getting?
It's 1 160, not 10.
160.
Okay, what are you guys saying?
1044
Okay. Then we come to variable what?
overhead.
Okay. That will be 720 divided by 800 multiplied by
840,000.
840. Okay, what are we having?
756.
756. So what will be our contribution?
One seven two eight.
1728.
1728. The first cost is what?
28.
972.6.
So the 972.
972.6.
So the fixed cost, you don't flex the fixed cost. The fixed cost does not change with the output level. Okay. So what will be the profit?
755.4.
So 755 point what?
Oh,
4. So you can also do this one like this, but this is going to be taking your time. So sometimes it's not about working hard, but it's about working what smart.
American.
Okay. So you have to come here and do the same thing. What someone will be doing is that the person will be busy what? Finding the selling price per unit. The person will be doing something like this. 6 million divided by 800,000. Then the person will now multiply by the 720. You can see that it's the same thing that you are doing over here, isn't it?
Yes, sir.
What you are doing there is the same thing. What you are going to, you find the selling price per unit and multiply by the unit that you are selling. It's the same thing that the person is also doing here. This is multiplication. So the 6 million can come to the top here over here. Then you divide it by the 800,000. It's the same thing. Don't find the selling price per unit before you multiply. No. The revenue is going to be based on the unit. The revenue varies with the unit that you are selling. So if 800,000 is 6 million, then how much will be 720,000? Yeah, a very small ratio and proportion, and you are good to go. Okay, but before you find the break even, you need to know the selling price per unit. So for the break even and those ones now, you can do the selling price per unit for each of them one by one. They are saying that nothing will change. The variable cost and all those things will still be the same based on the what? On this one. The variable cost will not be changing because it's vary with the level of output. But if maybe the fixed cost is a step up fixed cost, then if we are producing up to a particular level, maybe if we produce up to 750,000, the fixed cost will be this one. But if you produce any additional amount, the fixed cost will increase. So since you are now producing below the 750, then they can say that the fixed cost will be reducing by this amount. That will tell you that the fixed cost is a step upward fixed cost. It is up to a particular level. They can ask you, fixed cost is not relevant. Please, it's not true. Fixed cost is fixed up to a level of what activity. If you exceed that particular level, it means that you have to what? You have to now incur additional cost. You have to incur additional cost. All right, so let's come to this particular one now. The question is asking us something about okay. So they are saying that break even, based on the forecast activity for the year, calculate the break-even point in packet of biscuits, the margin of safety in percentage terms, the sales revenue required to earn a profit of this one, and the other issues. So before we can do this now, we need to know the selling price per unit. So let's now calculate these items per unit. We need to know our selling price per unit or the contribution per unit. The only thing that we need over here is contribution per unit, isn't it?
yes.
Yes,
The
sir.
contribution per unit. Okay. So I'll also show you another smart way of answering this one. So let's go there. What will be our contribution per unit now? based on the forecast sales?
So it will be the 1728 divided by
28,000 divided by
720.
720,000. Okay, what are we having?
2.4.
That will give us 2.4, isn't it?
Yes, sir.
So 2.4 per packet. That is the selling price. That is the contribution per what? Per this one. You can also calculate this one alternatively as this. So you count your selling price per unit. So the selling price per unit, you can either use the 5,400 divided by 720, or you can use the full amount divided by what? Divided by the budgeted amount. So I can use 6,000 over here divided by 800, which is a 6 million divided by that one. What am I getting?
7.5.
7.5.
7.5.
0.5.
Okay. So I'll be getting 7.5. Then I will now subtract my variable cost now. Okay, so the variable cost you can decide to use. So you bring your material cost over here. You can decide to use a total one, or you can decide to use these ones. So you can decide to use 2080 divided by 800. What are we getting?
2.6.
2.6. So you have your 2.6 over here. You do your labor. So your labor cost, you can decide to use the old one, 1160 divided by 800. What are we getting?
1.45.
1.45. Okay, so you count the variable overhead. You can do 840 divided by 800. What are we having?
1.05.
1.05. If you subtract, or what are we getting?
2.5.
Okay. So which of them do you like? Do you want?
First
The
one.
first one.
You see, the first one, the examiner will not punish you for doing this. Why? Because you have done a particular working. So this is just what? This is just a build-up what? Or this is just a follow-up question. So you pick the figure from what you have done. But if this is a major question, you are doing 2.4, and you haven't shown how you have gotten the 1728 for that one, then the ticks, you will not get a ticks for that one. So if this will just be a fresh question, then you have to show how you are getting your contribution per the packet or per the this thing that you are using. So we come here. How do we calculate our break-even in units? So we have our break-even point in unit over here. So we have shown this one. We say that this particular formula is derived from what? The perspective of economics. Total revenue is equal to total cost, break-even. So we now have our total face cost. How that is cool? Total face cost
Divided
by
by contribution per
contribution per unit. Okay. So contribution per unit. Okay. We know that at the level of at break-even, contribution is equal to what? Total fixed cost, isn't it?
Yes, sir.
Yes.
Okay. At break-even, contribution is equal to total contribution is equal to what? Total fixed cost. So you want to make the unit the subject. How do we get a contribution? It is the contribution per unit multiplied by the quantity that you are selling. So how do you make that particular one the subject? How do you make the quantity the subject? You divide through by contribution per unit. Okay. So let's come here. What are we having as a contribution break-even point in units?
So 972,600 divided by 2.4.
So 972,600 divided by 2.4.
2,400.
What are we getting?
405,250.
400
5,250.
okay.
05250.
Okay, so we have 4
05
5
250.
okay 50 packets, isn't it?
Yes.
These are in packets, so you write it in a packet. Okay. What is the next one that they are asking you?
The margin of safety
in percentage terms. The margin of safety, we are saying that the difference between what you want to produce and what you will be producing to break even. Okay, so we have the margin of safety. Over here, you have your budgeted quantity minus your break-even quantity
over the budget.
over the budgeted multiplied by what?
100.
So you can do this in what? In money terms, and you can also do it in what? In unit terms. So this one is 720, isn't it?
Yes.
Minus 405250 divided by 720,000 multiplied by 100. What is the final answer?
3.72.
43.
43.72.
Okay. So 43.72%. Okay. The next one is what?
The state revenue required to gain a profit of 1,140,000.
Okay. So they are saying that the sales revenue required to what? To make a profit of that figure, isn't it?
Yes.
Okay. So sales revenue required to make a profit of that. Sometimes so sometimes they can give you, I hope you can remember that we have solved a question where they have given you after tax. And we say that you should always what? Use before profit before tax, isn't it? Okay.
Yes.
So sales
Yes.
revenue required to get a revenue, to get a profit of, okay, that one we go there. Okay, let's come here. Let's come here. Okay. We know that we are saying that at break-even, contribution must be equal to what? Must be equal to the fixed cost, isn't it?
Fixed cost.
This was
Okay. But they are saying that we should be able to get a profit of 1440, isn't it?
Yes, sir.
This means that our contribution will be higher than the fixed cost by what? 1440, so that we can be able to get a profit. Is that correct?
Yes, sir.
Okay. So let's come here. If you come here, if you want to derive a formula for this one, it will be your contribution is equal to the total fixed cost plus the profit that they are talking about. Do you agree?
Yes, sir.
Yes.
Okay. And how do we find contribution? Contribution can be calculated as a contribution margin multiplied by the sales revenue. Contribution margin multiplied by the sales revenue or multiplied by the revenue. How do we get a contribution margin? What is the percentage of our what? Our revenue is what is going to be what? Is going to be treated or is going to be remain as contribution after taking away our what? Our variable cost. Okay. Whatever going to be the case, the contribution margin for the first point will still be the same as this one because the fixed cost, the selling price is not increasing, material cost is not increasing. So let's find our contribution margin over here. Contribution margin. So this will be, we have the contribution to sales multiplied by the revenue over here will give us our total fixed cost plus the profits. So we are looking for the sales. So the required revenue will now be equal to total fixed cost plus the profit required divided by the contribution.
Contribution ratio.
Okay. So how do we find the contribution ratio now? That is the problem. So we have our revenue.
the contribution
What are we getting for the fixed cost? 972,600, isn't it?
Yes, sir.
Plus the profit is what? 11.
144.
1,440,000.
Okay. So the contribution will now be what? Let's calculate the contribution to sales ratio. That will be our contribution divided by what?
7.5.
Okay, what are you getting? Investments.
0.32.
0.32. Okay, so this will be divided by 0.32. Put the two figures together and divide it now. What are you getting?
7539375.
753.
9375.
Okay. So I'm having 7539375. So this will be the revenue that you have towards. This is the sales that you have to make. This is the value of the sales that you have to make to be able to what? To be able to get this particular what? This particular profit of 1,400,000 what? 40,000. Okay, this is the simplest way to go about it. Don't go and be looking for someone can also try to look at what is the quantity that I have to sell. What is the quantity that I have to sell to be able to what? To be able to get this particular what? Amount. What is the quantity that I'll be selling before I can get a profit? So someone can do it from the what? From the quantity side. So someone can do it from the quantity side. And after doing it from the quantity side now, then the person will now multiply the quantity by the what? The selling price. So do this from the quantity side. Divide this one by 2.4 and see what you are going to be getting. So 972,600 plus 144,000. Okay.
Okay.
143 divided by 2.4 rather. 2.4. What are you getting?
I'm having 1005250.
So that is the unit.
100.
That is the unit that you are going to be selling. So you now multiply by your revenue, your selling price now.
And it gives the same answer.
Okay. Don't go and do that
75975.
one. Okay. Don't go and do that one. It will over you. Okay. So let's come to what's over here. So let's come to, we now look at the options now. Okay. Evaluate the profitability of the three options and recommend the option that the entity should adopt. So we'll be looking at that one now.
So,
Is it like
so what you do over here is you'll be maintaining, you'll be maintaining your original position of the 720. So you'll be looking at the increments that will be coming, or the options. Well, how are they increasing your revenue? Let's come here. The option one. So we do it for each of the options one by one. So let's go and do the profit for each of the options one by one. So profit statement. So statement of
Can I look at the last revenue that we calculated? The last one. Okay. All right, thank you.
okay. So we have statement of profit or loss for the options. So we'll be looking at the options one by one. So we have our option one over here. We have our option two over here. Then we have our option three over here. So we have the currency sign under each of them. Then we now move on. So you have your revenue. We'll be doing workings for the revenue somewhere and bring them. So let's now come to what they are saying. They said decrease the selling price by what?
By 20%.
Okay, it is as anticipated that this will increase sales volume by 20% on the forecast sales for the current year. Would this particular one be leading to any reduction in the variable cost? Would there be any reduction in the variable cost?
No.
No, sir.
Okay, unless the question is not saying anything. Sometimes the question can say that, okay, the volume, the sales volume is going to be reduced by what, 20%. What it means is that the variable cost will also be reducing by 20%. Because if the sales is reducing, the variable cost will also vary with the output that we are doing. But this one, this decrease over here is just like a discount that they are giving. So you will still incur the same cost for the what, for the production, but you are giving discounts to increase your volume. So this is going to be affecting only the selling price and the what, and the sales volume. The variable cost will still be the same. But if the question is just saying that the volume is going to be, the sales volume is going to be decreasing by 25%, it means that if you want to produce, you produce, let's say, 75%. 75% now, the variable cost will still be the same, but on total, the variable costs are going to be reducing. But this one, the reduction is on only the selling price. And this is going to be increasing our sales volume. So let's look at the new selling price now. So we look at the new selling price under the option 1. So let's come to workings over here. So we have another workings over here. Okay, so we have another workings over here. So we have, I will be doing the selling price over here. So we'll be doing the selling price. So we'll be having the options. Option 1. So let me just put options here. So I'll have the options here. I have 1, I have 2, and I have 3. So I'll be having my listing over here. So the selling price for option 1 will be what?
25 and it will be
The selling
Six.
price for option 1 is what?
Six.
It's
it will be
7.5.
6.
So
No.
7.5 multiplied by
by
0.8.
0.8. So it will
Okay,
be
so
6
0.8.
times
So that will give us 6,
7.5.
isn't it?
Yes.
Yes, sir.
So the 6, so that will give us 6 over here. Okay, option 2. What will be the selling price for the option 2?
Still
7.5.
7.5. Still 7.5.
That will be 7.5. But the variable costs are now going to be reducing, isn't it?
Right, sir.
Yes.
Okay. So let's come to, this will still be 7.5. Would there be any increase in fixed costs as a result of this one, or
Option 2.
Its cost will be decreased by 10%.
fixed costs will be decreased by 10%, isn't it? So that one we do it in the profit statement. Okay. We do the decrease in the variable cost also in that one. So let's come to option 3. What is the selling price?
Selling price will be 6.75.
So the decrease is what?
I think
10%.
it's 6.6.
It's also okay.
I'm having 6.75.
Yeah.
6.75.
Yeah,
Okay. And the
6.75.
fixed cost will be reducing by,
By 5%.
5%.
okay. So let's come to our revenue now.
This
So,
very
so let's come to demand. What will be the demand for option 1?
demand for one will be 900,000.
So they say this will increase the forecast sales by what?
By 25%.
25%.
1.25 multiplied by 720. I'm getting 900,000.
Yes.
Yes, sir.
Yes.
Okay. So we have 900,000. Okay, let's go to the second one. The second one, would there be any issue in the
No.
sales volume?
No, please.
So that will still be 7.
No, please.
Okay. The option 3, would there be any issue about the volume?
Yes. It's
Yes,
also
sir.
increased by
Yes,
25%.
So that will also be 900 again.
900,000. Yes.
Yes, sir.
Okay. So we have 900. What will be our total revenue?
Option 1 is
Option 3 is
5.4.
5.4. So that will be 5,400.
Yes. Yes, please. 5,400.
Okay.
option 3 is 6,075.
6,000.
and 75.
Okay.
Option 2 is also 5.4.
5,400. So we can go there and bring our revenues here. Bring our revenues here, and that will be 5,400, 5,400, and 6,075, isn't it?
Yes.
So that will be workings one. We are going to bring our variable cost. We do our variable cost and bring the what? The final answer over here. So let's do workings for our variable cost. So the first one is revenue. Let's have variable cost now. Okay, so the variable cost, the first one will be material cost. Okay. The material, is there going to be any reduction on this one?
No.
It will still be the same like the old ones, isn't it?
Yes.
So the total variable cost, so we have the material to be, so we'll be having material to be 2.6. So we have 2.6. Labor is what? Labor is 1.45.
1.45.
Okay. Variable overhead is what?
1.05.
Okay. 1.05, which gives us a total of what?
5.1.
Okay, 5.1. Let's come to option 2. Would there be any issue? Option 2. Would there be any issue on the variable cost?
No, but variable cost will decrease by 10%.
Variable cost decrease by 10%.
So let's find a 10% on each of them. Okay. So option 2, you say 10% decrease in all variable costs. 10% decrease in all variable costs. Okay, let me bring this one down some more. So option 2 is 10% decrease in what? In all variable what? Costs. Okay, so 10% decrease in the 2.6. What are we going to be having?
2.34.
2.34. Okay. 10% decrease in 1.45.
1.31.
Okay.
1.305.
Okay. Please don't approximate. We are going to multiply it. So 1.30 this one. So let's come to
1.35.
now I'm having 1.305.
Okay.
1.305. Yeah. 90% of 1.05. What are you having?
0.945.
945. The total will give us what?
0.59. 4.59.
So 4.59. Let's go to the last option. What is happening there at the last option? There's nothing going to happen to what? To the
variable cost.
variable cost. Please, these options, each of them are independent options. So we still have the 2.6, 1.45, and 1.05. That will give us 5.1, isn't it?
Yes, sir.
Okay. What will be our total now? We multiply by the demand for each of them, isn't it?
Yes, sir.
Yeah.
So the demand is 900,000 for the first one, 720,000, and we have 900,000. What are we getting for the first one?
4590.
4590. The second one is what?
The second one is 3304.8.
330.
4.8.
4.8.
Okay. The last one is what? The same figure as the first one, isn't it?
Yes.
Yeah.
So 4590. So we go to our statement over here. The variable cost will be 4590. 4590. And this will be
3304.
3304.8. What will be the contribution?
The last one is 1485.
1485.
The
first one is 810.
810. Okay.
The second one is 2095.5.
2095.5.
5.
5 or 2?
4.2.
Okay. So we come to our fixed cost now. Okay. Let's come to our fixed cost now. They are saying something about a fixed cost. Some of them will be increasing, some of them will be reducing. Would there be anything to the first one, the fixed cost?
No, sir.
So it will still be the same fixed cost, isn't it?
Same fixed cost.
Yes.
Okay.
Sir.
What is the amount for that one?
Nice.
9.
72.6. Okay. But the second one will give us what? 10% decrease. That will be the same for option 2. Is option 2 10%, isn't it?
It decreased by
Option 2 is 10%. Option 3 is 5%.
Okay.
So it's option 2 there.
875.3.
So this will be 0.95 multiplied by 972.6. Okay, so the option 2 is what?
875.34.
875.
0.34.
Okay. So 875.34. And this will give us what?
923.97.
875.34. 92.
3.97.
0.97.
Yes.
Okay. 923.97. So what is the profit for each of them?
0.97, sir.
97, sorry. Okay.
The last
97.
one is the option 3 is 561.03.
5.03.
61.03.
Okay.
First one, address of 162.6.
162.
6.
Okay.
And then the second one is 1219.86.
12.86.
19.86.
6.
86.
Okay. So which of these options? Let's say you should evaluate the what?
Option 2.
So let's look
The
at
option
it.
2.
So option 2 will be better. This is how they have been setting the question first. Okay. Evaluate the profitability of the 3 options and recommend the option that they should adopt. So they should adopt option 2 because that is going to be giving them a higher the highest profit.
Higher profit.
Okay. So I don't have to do anything. We have less than an hour. So I have to this one too is not a question about 2 is not a big deal. But someone is saying that I should go to let me do the management account in the public sector. Let's do that one first. Then we can now take our time to go to this one. But before that, look at this question. Question number 7. Just if you see this question, what will come into your head? If you see this question, what will come into your head?
That is not there. Hi, hello.
That will be
Sir.
Yeah.
We use high and low
High or
method.
low?
Yeah.
Okay. Don't go there and be saying that you haven't seen this is a high or
High
low
or low.
method. You are giving,
High and
so
low.
yeah. So it doesn't mean that they should give you different activity. They can also give you different years. They can give you different what? Different months also. They can give you for months. So this is just a high and low method. So how do you find the total cost?
Eugene is giving us feedback.
So how do you find the total cost here?
Sales minus profit.
Okay, so that is it. The highest level of activity is what? The highest level of activity is this one.
2010, 3,000, yes.
Okay, and the lowest level will be this one, isn't it?
1,500.
And its associated total cost over here, I'm sure that will give you two,
350 minus
280,000.
280.
that will give you 280. And this one will give us out.
Four.
427.
427,000, isn't it?
Yes.
So your variable cost per unit will give you the 427,000 minus 280,000 divided by 30,000, 3,000 minus 500. How that is okay?
Yes.
Okay, your total variable cost.
Sorry, it's 490. Yeah. It's 490 rather, not 427.
So 490.
Yes, yes.
Okay. So that will give us 490,000.
So I got 140.
140.
140.
Yes, sir.
Yeah,
Okay, 140 per unit, isn't it?
Yes,
per
sir.
unit.
That's the variable cost per unit. They say total variable cost for production of 3,000. What are you going to be getting?
140 by 3,000.
Okay, and what are you getting?
That's 420,000.
420,000.
420,000.
Okay, so 420,000. Okay, so that is the cost of that one. How do you calculate the total fixed cost? Who is this person?
Total
This
cost
is
minus
the
the
total
variable
cost
cost.
minus the 420.
The total cost is what?
490.
Minus what? The 420. What are you getting?
Yes. It's the 70,000. Okay, someone is giving us a feedback there.
That will give us
70,000.
70,000. You
Yes.
can even use the first one to calculate it. Okay, any of them. There is no problem with that. Okay, look at the 8. The 8, what can you do about the 8? The question number 8, what will come to your head?
The contribution.
Yeah, Ernest.
This one, I think, it's also about the high, but you have to use the sales at the activity level.
You have to use
The sales volume, like the sales values at the.
okay. So what we do is that we find a contribution margin. So use change in profit over what? The change in revenue. Okay, so that's how we go about it. Change in profit over what? By the change in revenue. The change in profit and then the change in revenue. That's how we go about it to find our contribution margin. So we find our contribution margin. So you'll be having this one as 130, okay, minus 80,000. Then you now have this one to be 1,400,000 minus this figure. Okay, what are you getting?
0.25.
Okay, this 0.25 will give you a contribution to sales ratio. Okay, so the profit volume, the contribution to sales ratio can also be called a profit volume. Know it from today. Can also be called a profit volume ratio. So what are we going to be having over here? The profit volume ratio is what, 25%? Is that correct?
Yes.
Okay. They are asking for break-even point in sales value. Break-even point in sales value. Can you calculate that? Break-even point in sales value.
Yes, I calculate the fixed cost and use the PR ratio.
Okay, so we can calculate the fixed cost. How do you calculate the fixed cost?
Using the high and low method again.
Or you don't have to use a high or low method necessarily. Let's come here. This is
The fixed cost is equal to the
okay, the fixed cost is equal to what?
contribution.
Fixed cost will be equal to what? Contribution?
Yeah, that's what I said.
No, they have profit over here, so it will be contribution plus the profit. How do you get profit? It is a contribution minus the what? No, this will be minus. It's supposed to be minus. Okay. Not plus. So it will be contribution minus what? Minus the profit. Because the profit is calculated as contribution minus the fixed cost. So if you are looking for the fixed cost. So if there should not be any contribution here, if they have zero, if the profit is zero, that is where we say that we are break even. So it will be the total fixed cost is equal to contribution. But this one you can see that they are making profit over here. So they are not break even. How do you get your total fixed cost? You just have this figure. Then you have 0.25 multiplied by the revenue for any of them. So that will give us 1,200 or 1.2 million minus a profit of 80,000. Okay, this is not an issue. This is a intro to management accounting. But I was thinking maybe some of us we haven't seen it before, and there can be a question on it. Okay, they can give you a question where instead of them giving you the total cost to use your normal high low, they will give you profit and what? The profit and then the volume. The profit and then the sales. You just find the profit to what? To volume ratio. The sales will now be the volume and the profit will now be the cost. That's how we do it. Profit, change in profit over change in revenue. That is very simple. So what are you getting over here as a fixed cost?
Okay, 220,000.
220,000.
Okay, so this divided by 0.25 will give us a contribution, will give us a break-even point in what?
In units.
Will give us a break-even in value. This is total fixed cost over contribution margin. That will give you a sales in what?
Okay.
In value. Okay. Profit when the sales value is what? Is 1,800. Who has an idea about how to go about this one? Profit when the sales value is 1.8 million. How do you go about it?
So you multiply the 0.25 by the 1,800,000
to get your.
And then
if you are doing that, what are you getting?
the sales revenue.
No, they have given you the sales revenue to be 1.8 already. And you are doing 1.25, 0.25 multiplied by that. What are you going to be getting at the end?
So that's the contribution.
What is the contribution? Okay,
That's the contribution.
Then you do what?
Yeah, so you'll be
So you
equating
multiply
if it's
the
Multiplication
0.25
again.
by the
You subtract
say
this one from the
say the
Then-
It will be
distance
it will be the
the
fixed
sales
cost plus the
volume is
profit over the
1.8.
contribution.
The
This is intro to
the
management
sales
account.
is 1.8. So
Okay,
It's
then
the
say
I
fixed
stop.
cost plus the target profit over the contribution per unit.
Okay, if you are doing that, you are doing different thing altogether. It means that you are now coming to find the value of the profit using the 1,800. We have the easiest way of doing this one. Yeah, Benjamin, you can talk.
the sales profit when sales volume is 1.8.
Yes, please.
So and we know that to get your sales volume, you have to take your fixed cost plus your profit divided by the contribution to sales. That's the contribution margin ratio. And
Okay.
we have our contribution margin ratio is 0.25. So you multiply the 0.25 by the 1.8, and we have gotten our fixed cost is 2,220,000, and you subtract it with that answer to
That
get
is
the profit.
okay. That is the simplest way of doing it. Okay. So you just find your contribution first. 0.25 multiplied by 1 point this one. Then you take your fixed cost from this.
obey no person you know now there.
Okay, then manage this one. That is how you go about it. But someone was also saying something. So you have your 1,800 here. Okay, then you know that for us to get the sales value is the fixed cost plus the target profit, which we are looking for, divided by 0.28. At the end of the day, you are doing the same thing. This will now multiply this one. So 0.25 multiplied by 1,800 is equal to 220 plus like this one. So the same thing that we are doing over here. All right. Okay. So I will leave the rest with you. I just want to, for me, the focus is about if you are giving profits. Who is calling my line?
Charles can do that.
So
Please,
Ah.
listening.
so this one, please let's pay attention over here again. We know the normal that we are okay with is what? Is the what? Is a high low with the cost. Okay. But if you come over here to, how do we go about it? Okay, we find the what? The contribution margin. How do we find the contribution margin? Is a change in the profit over the change in revenue. So you have this 130 minus this one. Then you also have what? The 1,400 minus this one as the denominator. The figure that you are going to be getting over there will be your contribution margin. So you can now use the contribution margin to now manipulate things to get or to answer whatever they are telling you. Okay, to answer whatever they are telling you. Okay, so let's come to this one. I actually want to show you how we are dividing the profit. We are doing profit over the revenue, but actually there's no time. Management accounting in the public sector. Charles.
Question number 1. Antoa District Assembly, ADA, is considering investing in cocoa farming or kente weaving business in order to generate jobs for the teeming, unemployed, and help reduce the youth migration problem that has bedeviled the district for years. The following cash flows have been generated for each of the proposed business concepts. Engagement with the district chief executive has revealed that the district is willing to spend 200,000 Ghana cedis on one of the projects. We have cocoa farming and kente weaving with annual cash flows, whether in or out. The cocoa farming and kente weaving business are expected to have scrap values of 15,000 and 25,000 Ghana cedis respectively. It is the policy of ADA to accept projects that pay back in a maximum of 3 years or with a discounted payback of a maximum of 4 years. ADA's cost of capital is 18%. So required, determine which of the business should be undertaken by ADA using the following investment appraisal techniques. A. Payback period. B. Net present value approach. And C. Discounted payback period.
Okay. So this question, we capture it from that intervention that they are doing. So Sometimes you have to be smart. If you are working, you have to be smart. Okay. So let's solve that one and pick additional one. Okay. So this one, the question is about, this is how you are going to be seeing the question. Please don't go and be paying attention to, you see, sometimes it's not easy. So if not for the intervention, so we will be focusing on the lecture note that they have over there as cost benefit analysis and those ones. You are saying that management in public sector, if the private sector techniques are going to be relevant, why can't you keep them and bring the new ones that you are bringing? You have taken all of them and added 2 pages, and you even redesign the manual and now increase the price. Hey, Africa.
Maybe need.
Okay. So they are saying that payback, whenever they say payback, please, they are talking about the basic payback. Basic payback. So they say payback method. We don't discount over here. We just use the cash flows the way they are. We assume that the cash flow is going to be the same in whatever year that we are going to be looking at. So we assume that the cash flow is going to be in the year that we are going to be looking at. Okay. Please, what will be the initial investment? You can see that this question, they are not giving you initial investment, isn't it? But you have to be very smart to know the initial investment over here. We are undertaking only one of the projects, isn't it?
Yes, sir.
Yes,
With an amount of what?
200,000.
200,000.
So if we are going with cocoa farming, we still be having what? 200,000 as the initial
200,000.
investment. If you are going for kente weaving, you'll still be having the 200,000. So the initial investment for each of them is 200,000. So we want to determine when this particular project will be paying us back. So we look for the 2. We do the payback period for the 2 of them, and we now decide the one that we are going to be looking for. So we look at the payback period for the cocoa farming. So we have the payback period, we have the years over here, we have our cash flow, we have our cumulative what? Cumulative what?
Balance.
Balance. Okay. You don't have to forget. Okay. This question you have to get all the 15. Okay, say amen.
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 Okay.
I receive it.
Amen.
This one will be very simple. The public sector now will now be very simple as compared to the private sector. Okay, because they are not going to be bringing complications in a question like how it will be in the private sector. But you have to look for issues of inflation also. How do we inflate it? We have spoken about that one. Okay, so let's come to the year 0, which is now. So the year 0 now is the project is currently owing us 200,000, isn't it?
Yes, sir.
Okay. So we still have the 200,000. You can see that year 1 we are making a loss, isn't it?
Yes.
Yes.
And the project will still be owing us what?
4,000.
4,000. Okay, so let's come to year 2. What is the cash flow?
12,400.
12,000.
400.
400.
Okay, how much will be left after the 12,400?
191,600.
Okay, 191,600.
91,600.
So year 3, what are we getting?
70,700.
70.
1,700.
700.
700.
70,700.
What will be the balance?
120,000.
120,900.
Okay, 120,900. This one, the payback period is more than 3 years. Okay, but they are saying that the minimum is 3 years. What are we having here?
86,200.
86,200. How much will be left?
34,700.
34.
700.
700. Year 5, what are we having?
100,000.
Okay, 100,000. So the balance over here will give us what?
Positive 65,300.
65,300. So the project is paying back in 4 years and some
4 years,
months.
4 months.
Okay. So let's come to the payback period now. You calculate the payback period. So the years, the number of years prior to the payback. So we need 34,700 out of the 100,000 multiplied by 12. I hope you can remember that.
Yes, sir.
Yes, sir.
Okay. So what are we having there?
4 years, 4 months.
4 years
4 months. 4 months.
and 4 months. If you can change the month, if you can easily change the month to years, so that will not be a problem for you. So that will be
4.4. Yes. So that will be 4.35 years.
no.
I think it's 4.4.
No. You have to mention this thing like what a business student or accounting student.
4 years, 1 quarter.
4 years what?
Well,
That's not 1 quarter. Quarter will be 3 months.
Yeah, but I don't know how to add 1 month.
Okay. Just say 4 years and 4 months. Okay. The 4 years and 4 months, and you move on. So let's come to the Kente business. I'm sure that the Kente business will give us a better alternative in terms of this one. So the Kente weaving now will give us the years over here. We have the cash flow and we have the cumulative what? Balance over here. So we have this thing and we have this one. So year 0 will still be 200,000, isn't it?
yes, sir.
Yes, sir.
Because it's the same amount that what we are investing. So let's come to year 1. What is the cash flow?
35,000.
35,000. And this will give us 165.
Yes, sir.
For this one, don't joke. There is money in it. The Kente issue. Okay. After you chat out, you count so that we can do it. Okay. The year 2 is what?
102,600.
102,000.
102,600.
Okay. This one they are cashing out. What will be left?
62,400.
62,400. Year 3 is what?
9,300.
9,300.
Yes, sir.
Yeah, 9,300. How much will be left?
Positive 29900.
Okay. Do you know why this one like because you have to make a decision, isn't it? You have to choose one of the projects. Okay.
Yes,
You
sir.
have to 21.
299.
Okay, 299. So you have to choose one of the projects. So one of them have to pay back within the stipulated time. This one you can decide to stop over here, but you can decide to continue because you can actually calculate your payback from here. Okay, so year 4 is what?
28,700.
700.
Okay, 28,700. The total will give us what? And we didn't consider the scrap value, but there's no problem. Whether you consider the scrap value or not, the payback period will still be the same because the scrap value will be at the end of the year, isn't it? It's a cash flow coming in at the end of the year. Are you okay? Okay.
Yes, sir.
So it will not actually have effect on your payback period. So it is the
Yeah,
scrap
price
value
will be
so that will be 50,000 or
25% over 50.
okay, that will be 50,000. So this one we have to change this one too. But I'm saying that this will not actually what? This will not actually okay. So this will not actually alter your payback period. Okay, it will still be the same one. So if you don't factor that one too, that will not be a problem. So let's
Current is
now
115.
okay. So let's now limit it to the normal cash flows now. Okay, so we have a 25. If it should be for the discounted one, then you have to factor it. But this will not actually affect your or payback period if you are using the scrap value. So let's come here. This will affect your calculation here. Let me come here. Let me just do this one here. So this will be 125,000, isn't it? Is it 125?
115. 115.
Okay, this will be 115, isn't it?
Yes, sir.
So it means that this will not affect our this figure now. So what are we going to be having?
$80,300.
This will now be 3.6 months. Okay, I want to recalculate this one. Okay, but this one, the payback period, you can actually put those figures there now. But let's go to the payback period for this one. So this will be 2 years and some months, isn't it?
And 8 months.
Okay, so that will give us, we need 6,200 out of the 92,300, isn't it?
Yes, sir.
Okay, so divided by 92,300 multiplied by 12. What are we having?
8.1.
So we have 2 years and what?
8
8
months.
months.
8
6
months.
months. Okay, so which of the project that they are going to be accepting based on payback period?
Okay.
Okay, because they say that the payback period, the maximum is 3 years, isn't it? But the discounted payback period is what?
4 years.
Okay, and the advance cost of capital is this one. The discounted payback period, how do we go about it? We just find the present value of the cash flows. So then when we consider time value of money. So we are going to be doing the NPV approach for each of them. So we now have the B over here, which will be the NPV approach. NPV approach of, so we have the years over here for the first project, that will be cocoa farming. So we have our cash flow here, we have our discount factor, then we have our PV. What is the cost of capital?
18%.
18%. Okay, so year zero will give us what? 200,000. Okay, the discount factor will be 1.00, and this will still be 200,000. Okay, year one will be negative, isn't it?
Yes.
What will be the discount factor?
0.847.
0.847.
7.
Okay, year two, let's just copy the cash flows. 12,400. Year three will give us 7,700.
70,000.
Year four will give us
200.
86,200. And year five will now be 1,115, isn't it?
115.
So you consider the what? You consider the scrap value. If there is an issue of working capital, you consider that one too. I hope you can actually remember that issue of working capital. The working capital will be recouped at the end of the project. Let's come to these figures. The discount factor for each of the years.
Year 2 will be 0.718.
0.718.
718. Yes.
Okay. Year three is what?
Year 3, 0.609.
609. Year four.
0.516.
Okay. Year five.
0.437.
437. Okay. So let's come to, so you can find, let's do the what? The Kente one here. Okay, the Kente revenue should be, we have our years over here, our cash flow, our discount factor of 18%, and we have our present value. So we have year zero, 200,000. discount factor 1.00, and we have 200,000. So we have year one, we go and copy the cash flow over here, 35,000. We copy the discount factor also, 0.847. Year two, 0.718. The cash will be 10 to 600. Year three will be 0.0609. Cash flow will be 92,300. Year four, we are having 28,700, and the cash discount factor is 0.1516. Year five, the cash flow itself together with the cash flow itself together with the together will give us 50,000. So we have 50,000. If there's a working capital, it will be recouped at the end of the project, isn't it? So we have
Yes.
0.437. So you factor when the working capital is coming in and when you are recouping it. So let's find their present values now.
For co-farming, year one is 3388.
33 as negative.
Yes.
Yeah, two is what?
Year two is 8903.2.
03
03.2.
Okay. Yeah, three is what?
430.56.3.
430.56.3. Okay. Yeah, 4.
444. 79.2.
444.
79.2.
Okay. 79.2. Do you have any of these amounts in your account? Let's see how you are mentioning the figure like the figure is your size.
50255.
502.
55.
What will be the present value? What will be the NPV? I don't know who has given education to us. Football is there. But oh God, we didn't try. But we don't have anything to say. So let's go here. 444. Auntie Vic, do you know that Mbappe's bonus, just a match bonus, can take care of you for 20 years?
I have no idea.
Okay, I'm telling you. Okay.
Please, the NPV is 56694. Someone should please confirm me.
We are not concerned about that right now. We are concerned about Mbappe's salary, Mbappe's allowance taking care of you for the rest of your life.
4656694.3.
Okay, negative end.
Yes, it's negative.
Okay, you are there saying that you want ICA certificate. Instead of you to go and be there and be, at least they will give you bonus. You can travel. The traveling to is also, what are you having?
56694.3 negative.
Okay, 56694.3. Okay. Charles,
Hello, sir.
are you there?
Yes, please, I am.
Do you know that after you charter and you are working, before you complete school and you start working, do you know that it will take like 2 years before you can get this amount? It's not your gross salary because you are going to be buying items. So your net amount can take you like 2 years before you get a 50. This is 56,694.3. 30 pesos was on it.
Not even 2 years.
Okay. So it's not easy.
2 years.
The system is not easy. But how you will do it? The rest is with God. Let's move on.
Farming add investment money.
So we have 2
Yeah,
9.
man, 1 month salary.
1 month you are talking about is weekly. Is a week salary can take.
That's small for 18 years.
It's
Then if
weekly.
you become a politician, you get it.
He weekly salary can buy me as a pet. 10, 200, 600. I don't blame anybody. I blame my mom. She should have given birth to me in Spain or somewhere. At least I'll be better. 7-3,
It's you that don't have talent.
6-6. The talent is there. You cannot do well in Ghana with talent. Okay. The environment will kill you. A small girl will be what? Will be reading. Someone with 2 months will be reading 1, 2, 3. They will be calling the child to be what? To be a miracle, or maybe she's a spirit or something. The talent has died. Okay, Africa, we don't have room for those issues. Yeah, what are we having? 0.060.
6 to 10.7.
Okay. Sometimes
Five substitute 10.7.
I don't have anything to do. Year 4 is what?
14809.2.
So 2 is 700. Okay.
21850.
The last one is what?
18.
21850. 850.
21850. Okay. What is the MPV?
3818.3.
3818.
The last one, the cash flow is 25,000. No.
No place. It means that you are not following us.
Please add the scrap value.
The scrap value will be a cash flow at the end of the year. The 25,000, the normal cash flow. By the end of the year, you will sell whatever machines that you are using for the farming or whatever. You are going to be selling it, and you will be getting 25,000. So that will give you a total amount of what? 50,000. 3818 point what?
3.
Okay. So which one are we accepting based on the MPV?
Project Kente.
Okay. So this one, if you use the discounted payback, this one, you will not even get what? You will not even get, the project will not even pay back before the project. Okay. So
It's negative. It's negative.
Which one? The cocoa farming?
Yes.
That's what I'm saying, that it will not even pay you back before the end of the project.
No, they're different. The Kente is negative.
Kente is negative. Hey, are you sure?
Yeah, it's negative, sir.
Hey.
Yes, Kente is negative.
It's negative.
So it means that we are not going to be picking any of them based on MPV.
Yes, sir.
Yeah.
Wow. So it means that none of them will be paying back if we are using what? The discounted payback period. So let's use a discounted payback period. I'll just demonstrate what we mean by it. It's the same as the first one, but with this one we use discounted cash flows. We use present value of the cash flows. So you still have your years over here. You have your cash flow. Then you have your cumulative what? Cumulative balance over here. So you have your cash flow in Ghana cedi. Cash flow in Ghana cedi. So you have year 0. That will still be giving us a 200,000. The project is currently owing us 200,000. Okay. So year 1, the discounted, the present value of that is 3388. What will be the accumulative balance there?
2033.
Okay. Year 2, what are we having? 8903.2. What will be the difference?
One 19448.8. 4484.8.
Okay. What will be the balance over here? Year 4?
151. 42815.
151.
42815.
Okay. So we come to the year 5 is 50255.
106.
255. So 10.
949.5.
949.3. So this one will give you the closing balance over here, which is a 566 94.3. I'm sure that is the same.
Yeah.
Okay. So it means that this one you will not pay back. Okay. So you don't have to calculate payback period because this project is not paying back. So you do the same thing for the Kente also. Okay. So you do. So for the discounted one, we use the present value. You have to find the present value of the cash flow before you use it. The same calculation, but just that the cash flow is going to be a discounted cash flow. Okay, let's look at the last one over there. And we look at what will happen. Okay. That's right there.
Yes, please, I am there. So question number 2. Akonta district has excess funds of 200 million Ghana cedis and is looking for attractive investment opportunities that will yield a return of 15% per annum, or better to deploy the fund. An extract from a feasibility report submitted by a team of investment and project experts is as follows. So we have project A to E with their initial investments required and their constant annual cash flows and their projected life or their project lives in years. The cash flow per project is constant for the lifespan of each project, and each project is divisible by the purpose of capital allocation. The required A. Calculate the NPV of each product, and B. Rank the project using profitability index and allocate the 200 million among the projects.
Okay, so let me before we continue again, I want to tell you that for this one, for investment appraisal purposes, we use what? Which of the cash flow do we use? We use relevant what?
Relevant cash flows.
Okay, so they can say that the entity, the planning department or whatever department has undertaken feasibility studies and they have incurred a cost of the. See, that is a sunk cost. It's a cost that will be incurred anyways. It will be incurred even we are going ahead with the project or not. It will be incurred. So it's not arising as a result of the decision to undertake the project now. So that will be treated as a sunk cost. We use future cash flows. There can also be a committed cost. Ignore the committed cost. The committed cost is just like you are saying that, okay, I'm going to be paying this amount for this. You are here to take the item. So you are committed to do something. Commitment does not mean that you are going to be what? You are going to be. It's just, commitment does not mean that you are going to be buying that thing. So you ignore the committed cost. There can also be a research and development cost where it will be paid in the future. That future cost is relating to an event that happened in the past. That should also be treated as what? As a sunk cost, whether they are paying now or they are going to be paying in the future. It's a cash flow base arising from what? A past decision before the actual decision. So you have to pay attention to those issues. Okay. So let's come here. This is actually so many projects. I'll pick it from financial management question. So one thing I want to say about over here is the profitability index. How do we go about it? That is the only issue over here. So you can see that the initial investment, we are having 200 million, and we want to see how we can do the combination of the projects. We have project A, B, C, D, E. Okay. And the initial investment for each of them is 80 and a constant annual cash flow. So every year we are going to be receiving 36 million from this particular project. For how many years?
4 years.
Okay.
4 years.
So we can use what for that? We can use annuity for that, isn't it?
Yes, sir.
Yes.
Okay. So we can use annuity for each of them. So we have the first project to be project A. So we'll be using annuity. We have the years, we have the cash flow, we have the discount factor, then we have the present value. What is the discount factor?
Wow.
15%.
Okay, 15%. So year zero, what is our initial investment? How much are we investing here? 80 million, isn't it?
Yes, sir.
Okay, this will be 1.00, and this will give us negative 80 million. I'm reducing the figure to million. Okay, then we are going to be receiving cash flow for how many years? 4 years. So 1 to 4, that will give us 36 million. So we use annuity. Annuity will give us 1 minus 1 plus r exponent negative n, all divided by r. Please, you only use annuity when the cash flow is going to be the same every year. That is an annuity. It's the same amount. It's an equal amount for a particular period of time. That's annuity. But if the cash flows are different, like this one, we do it one by one. They are all going to be treated as future values. Okay. So let's come to this one. But if you have time, you can do 1 to 4, 36, 36, 1 to 4. That's going to be taking your time. So the 36, 1 to 4 that you are going to be doing, you can just add the discount factor for the 4 years. If you add all of them together, that is what we call the what? The annuity. What are we having?
2.855.
2.855. So if you multiply, what are we having?
102.78 million.
102.78.
So what will be the MPV now?
22.78.
22.78. Okay. So let's come to the second project, project B. We have the years over here. We have the cash flow, discount factor of 15%. Okay. We are going to be using the same discount factor. The project we are the one undertaking, so we use the same discount factor to appraise them. So year zero, what is the initial investment on this one?
40 million.
40 million. And 1.00, 40 million. Okay. How many years? What is the project life?
3 years.
3 years.
So that will be 1, 2, 3. How much are we receiving?
23 million.
So 23 million. So what will be the discount factor? The annuity factor rather.
2.83.
2.83.
No,
Okay.
283. 2.283.
Okay,
283.
2.283. So what are we having as the present value?
52.
That's 52.51.
52.51.
51.
Okay. What are we having?
12.51.
That's 12.51.
Okay. So let's go to the project C. The project C, we have the years over here, cash flow, discount factor, then we have present value. So year zero, what is the initial investment?
78 million.
Okay, so you have 1.00, 78 million. How many years?
For 5 years.
Okay, cash flow is what?
30 million.
30 million. So what will be the discount factor?
3.352.
352.
3.352. So what will be the
100.56.
100 points?
56.
Okay, 100.56. What will be the difference?
22.56.
22 point what? 56. Okay, so we have year 0. The investment is what?
40 million.
40 million. So 1.00, we have 40 million. 1 to what?
4 years.
1 to 4, isn't it?
4
Yes,
years.
sir.
So we can actually copy the annuity factor from that one, 2.855. What is the cash flow?
20 million.
20 million. What are we having?
57.1.
57.1.
0.1.
That will give us 17.1, isn't it?
Yay, hello.
Yes.
Eight cities. You.
Yes. So we have cash flow here. Discount factor of 15%. 15% or 15%. Then we have the present value here. The initial investment is what?
40 million.
40 million. For how many years?
3 years.
Okay. So 1 to 3. We can copy the discount factor from somewhere, isn't it?
Yes, sir. Project B.
Okay.
0.283.
2.283. So what is the cash flow?
22.
22. So what would be this figure?
50.226.
What?
50.226.
Just mention it again.
50.226.
So 50.2.
2, 3. 3.
Okay. So this will give us 10 point what?
0.23.
Okay. So this is the present value. Okay. The question is saying that these projects are divisible. Divisible means that you can undertake part of the project. You can undertake part of the project. So if you can undertake the part of the project, we use profitability index. The question can also say the project is not divisible. It means that you cannot undertake part of the project. So what we do is we look for the best combination to use the money. But this one, the question is saying the project is what? Is divisible. So we use profitability index. How do we determine the profitability index? It's just a percentage return that we are getting on all the investments. So you can see that this particular project, we are investing what? 40 million. The E, we are investing 40 million, isn't it?
Yes, sir.
But how much is the return that we are getting?
10.23.
So someone can say, what is the percentage of the return? So we can actually find, please, you cannot say that they should go ahead with the project with the highest amount, which is 22.78. No. 22.78, you can see that the amount that we are investing over there, we are investing 80 million. So 80 million, if 80 million is giving us 22.78 and 78 million for 5 years, they are having different amounts and different useful life. So we don't have to just look at what you are using a project, you are undertaking a project for 3 years is giving you 10.23. You are investing 40 million. In a particular project, you are investing 80 million for 4 years and it's giving you 22.78. No, all things being equal, this 80 should give you the same amount. It should give you something higher than what you are getting from the 40. But if they are all should be 40-40 with the same cash flow and with the same useful life, then we can just go ahead and compare their NPV. So what we do over here is we calculate what we call profitability index. The profitability index, it can be calculated in 2 ways. You can either do the NPV divided by the initial investments. You can either do this one or you can do your PV over the initial investments. Okay. So how many times is the project paying your initial investment? This is for this one. For the PV, it is the number of times that the project is paying you. Okay. That is for this particular one. But for for the NPV over the initial investment, it's just a return on the investment. This is the NPV. So you are investing 40 and you are getting 10.23. So what is the return in terms of percentage? So we are just looking for the percentage return. What is the return that we are getting on each of the projects? We do it for each of them one by one. So we come to the first project. We have project A. So what is the return? It is going to be 22.7.
0.78.
Okay, 22.78 divided by 80. So what is the return in terms of percentage? But that percentage will be decimals. We don't have to multiply by 100. I'm getting
0.284.
Okay, 0.2.
85.
Okay, can we approximate to 3 decimal places?
So 0.285.
0.285.
So that will give us 28.5%.
5%.
Let's count to project B. Project B, what is the return that is given to us? 12.51. 12.51 divided by 40. Is that correct?
Yes, sir.
Okay, what are we having?
0.313.
0.313. So that is 31.3%, isn't it?
Yes, sir.
So you have your project C. Even if you don't know the profitability index, you can't remember. Just say that you are looking for the return on what? On investments. So the return on investment, your return over the investment multiplied by 100. Your return over this one. So we have, what are you having? Okay, let's come to C. C is 22.56 divided by 78. What are you having?
0.289.
0.289. Okay, so let's come to project D. Project D is what?
17.1 over 40.
17.1 over 40. What are you having?
0.48.
428. Okay. So let's come to the last project. What are we having?
10.23 over 40.
10.23 over 40. What are we having?
0.256.
0.256. Okay. So you come to the allocation of the scarce resources now, allocation of funds. So we do it in a table form. So we have the project over here, project over here. So we have projects. Then we have the fund or the initial investment. Just sometimes they can ask you to calculate the NPV. So let's come here. Which of these projects is paying is the highest paying project?
Project D.
Okay, so we start with project D. How much will be invested there?
40 million.
40 million.
So we have taken 40 out of 200. We are left with what?
160.
160.
What is the NPV for this one? 17.10, isn't it?
Yes, sir.
The second one is what?
Project B.
Project B.
Okay. B, the investment is also
40.
40.
And it's giving us
51.
12.51. The third paying is what?
That's C.
C.
C is giving us 78. So this will be left with 120. And we have taken 78 out of 120. What are we going to be left with?
It should rather be A.
No.
No,
Supposed to be
this is 0.285 and 0.289. 22.56. What are we going to be having? What will be the balance that will be left? 40,
42.
40, 40. That will be left with 42, isn't it?
Yes, sir.
What will be the next one?
A.
Okay, A. Can we invest all the money in the A? Can we
No.
have all the
No,
80?
No.
no, sir.
Okay. So we only put the remaining there. This means that the project is divisible. You can undertake part of it. So you find the respective MPV. Okay, what is the total MPV from the 80?
22.78.
22.78. So 22.78 is based on investment of 80 million. So how much will be for 42? So we just do 42 over 80 multiplied by 22.78. What are you having?
11.95.
11.96. Okay. We are doing the MPV because sometimes the question can ask you to rank the project and find their respective what MPVs. This is how we go about it. A very simple issue there. Okay. A very simple issue there.
Please do the allocation again. Allocation. My network went off.
The meeting is recorded, senior.
So please, what did you write there? The project, then there. I think that one is a friend or
Is the fund. Friend how? Senior. Friend how? Senior how? How can a friend be here? Okay, senior, the project allocation is based on a percentage of this is the figures that we have calculated over here is the return on the investment. So we allocate it based on the one that is paying us, that is giving us the highest return. So the first highest return is D. So we put 40 million in D. The second one is this one, we put 40 million there. The third one is this one, we put 70 there. And this one is 0.285, but we cannot put the full amount there. So you put only the remaining amount there. That's how we go about it. A very simple exercise there. Okay. Any issue?
no,
Yeah, I
sir.
think someone was asking that to do explain question 3 or something.
Chairman, I'm tired. We are officially done with management accounting. Make it a point to solve at least two questions under each of the topics. Okay, if you are coming to learn contemporary approaches to management accounting, set target for yourself. Solve questions at least a day. You should be able to solve 2 questions each or 3. 2 is 24 hours, you are solving 2 questions. Are you telling us that you are using 12 hours to solve 1 question? No. At least solve 6 questions within 24 hours. Okay, so you are using 1 hour. You can also go and print a past question. Don't print the solution. Print the past question and set time for yourself, 3 hours, and say that you are coming to work it and see whether you can finish before within the 3 hours. If you cannot do that one, then you can actually work on your speed now. The speed is also okay. So you go, so make it a point. Okay, if you have any issue, I'll be dropping questions on the page. You can be trying them. But me, I have done my part. Okay, now you are the one in charge. You will be there. I'm not God. You cannot mention my name in the exam hall and miracle will happen. Okay, so that time is between you and your God. Okay, but God will never come through for you if you are not prepared. Okay, God is not from Africa. Okay, so make it a point, at least 3 questions or 4 questions a day. So your standard costing, at least if you're able to solve some technical questions, 4 questions, I don't think you go there and you see that MA is worrying you, no, because we have done so many things that will make you be in the position to pass. Seniors, thank you for coming. I'll see you guys after the exam. All right.
Bye bye. Thank you.
Okay.
Thank you, sir.